So friends, as you all know, we are starting the third chapter, that is profits or gains from business or profession, which is again an important chapter for our final examination. Without this chapter, it is very impossible for us to crack our either CA or CMA final. For both examinations, this is one of the most important chapter. So we'll do one thing. We will be having a detailed discussion on this particular chapter. So listen. As you all know, the chapter's name is Pgbp. This is the first official head that we are about to discuss. First of all, as you all know, if an income forms part of the total income of an assessee, then if that forms part of the scope of total income, then you need to process that particular income under 5 heads. Head number 1, salary. 2, house property. Third one is Pgbp. If an income that forms part of scope of total income, which is connected to your business or profession only, then you need to process it under Pgbp. If that particular income have a business nexus or it has some connection with your profession only, you need to compute the total income under the head Pgbp. So under every head of income, there is a section called as charging section. With respect to every head, there is a section called what? Charging section. In salary, it is section 15. House property, it is section 22. Pgbp, it is section 28. Capital gain, it is section 45. And IFOS, it is section 56. So charging section, what is the role and what is the importance of charging section? Charging section is just like a magnet where it attracts income from scope of total income to that respective head. Are you with me? If a particular income have to be processed according to the charging section of a respective head only, you need to process it under that respective head. So the first important thing that we need to study in this chapter is section 28, that is charging section of Pgbp. This is our first discussion in this chapter. Before moving on to this, tell me what you mean by business. Business means any trade or a commerce or a manufacture which is intended for what? To earn profits, and which is done on regular intervals. That means there should be a recurring activity. What do you mean by recurring activity? You have to do it again and again and again to generate more profits. So business activity should be always recurring. An activity or a trade or a commerce which is done on a regular basis with an intention to earn more profits can be called as what? Business. Now what do you mean by profession? If a person is making use of his skill, experience, expertise, etc. to generate income, then that particular income can be called as a professional income. It is not necessary that that particular person should have a degree certificate or a recognized or a recognition from any university or something. It's not necessary. If you can generate income by making use of your experience, definitely we can say that income is a professional income. Say for example, I'm an actor. I haven't studied in any film school. I'm directly into acting and I'm earning income. Definitely that income is a professional income. So it is not necessary that you have to undergo any training or you have to clear some examination or you have to get some certificate and all. It's not at all mandatory. So whatever income that you have from your business or profession will be processed under the head Pgbp. Now, every head, there is a thing called year of taxation. What is that? Year of taxation. In salary, under section 15, what it say? Either due or receipt, whichever is earlier. So salary income is taxable under the head salary, either on due basis or receipt basis, whichever is earlier. House property income is taxable under the head house property on an annual basis. We call it as gross annual value. It doesn't depend upon the receipt. It doesn't depend upon due. It doesn't depend upon any books of accounts maintenance. It's all about an annual value will be taxed every year under house property. In Pgbp and IFOS, incomes are taxable based on the method of accounting followed by the assessee. Section 145 says about the maintenance of books of accounts and its importance. So, according to the Pgbp and IFOS, this is IFOS, An assessee's profit have to be computed in accordance with the method of accounting that he followed when he maintained his books of accounts. According to the income tax law, there are two recognized methods of accounting. You all know it. Number one, mercantile system of accounting and cash system of accounting. You tell me, what is mercantile system of accounting? Whatever income that is receivable will be considered as your income. Whatever expenses that are payable will be considered as your expense, irrespective of the fact that whether it is received or whether it is paid. Whatever income receivable is your income. Whatever income that you earned is your income, and whatever expenses that you have incurred or payable is your expense. And the next is cash system. What is cash system? See, an income or a receipt or a income is recognized as income when it is actually received. A payment, an expense is considered as a payment, or expense is considered as a deduction when it is actually paid. So, in cash system of accounting, things are very simple. Whatever you received is your income, and whatever you paid is your expense. That is what is called cash system. So, when you maintain books of accounts, you have to follow with the ICDS as well. You have to follow with what? ICDS. That is the Income Computation Disclosure Standards. See, you will maintain the books of accounts in accordance with the accounting standards. But when you compute the total income, you have to follow Income Computation Disclosure Standards. So, we can conclude that the profit is computed as per the books of accounts maintained by the assessee in line with ICDS. Your maintenance of books of accounts is important, but while computing the total income, you have to follow ICDS as well. So, whatever profit that you get by following the method of accounting as well as ICDS shall be the profits under Pgbp. This is what we can say in general. Are you here? So, we will start with section 28, that is income chargeable under the head Pgbp. Which all are the items that are taxable under the head Pgbp? That's what our first discussion in this chapter. So, we will start with each and every item under section 28 Pgbp, income chargeable under Pgbp. First of all, listen friends, we can divide section 28 into two. Number one, general provision, and number two, specific items that are chargeable under Pgbp. General provision means what? The first one, income arising to any person by way of profits and gains from profession, business or vocation shall be taxable under Pgbp. Whatever income, whatever direct profits that you are earning in connection with your business or profession or any other vocation shall be taxable under Pgbp. That's actually a general statement. Whatever profits that you are earning from these activities shall be taxable under Pgbp. Now, along with the general chargeability point, there are certain specific items that have to be always processed under Pgbp. What do you mean by specific items that have to be processed under Pgbp? The following items which we are about to discuss always have to be processed under the head Pgbp, whether it is directly connected with your business or not. These are specific chargeable items under Pgbp. So, the following always have to be considered as a income that are taxable under the head Pgbp. What all are the specific items? Item number one under specific category is any compensation received on account of termination or modification of a contract which is connected to your business. That is obvious. Say you have a contract which is connected to your business and there is a termination, that means a cancellation, or there is a modification, that means an alteration of that contract, and due to the termination or modification you are receiving a compensation. That is not your direct business profit, but it have to be taxable under the head Pgbp. So, if there is any compensation that any person receives, either due to termination or modification of a business contract or a professional contract, have to be assessed under Pgbp. Are you with me? Now, moving on to the next one, point number two, that is income derived by any trade, professional or similar association from specific services rendered to their members. Income derived by any trade or a professional or similar association. The question is, what do you mean by trade, professional or similar association? What is this trade, professional or similar association? Bar Council of India, Chamber of Commerce, etc. are the classic examples for trade or professional or similar association. Are you with me? Say bar council or chamber of commerce, or we will take another example, say film actors association. Film actors association. So you tell me, what is the main purpose of these trade, professional or similar association? Or what is the main purpose of film actors association? In every state there will be a film actors, that corresponding states film actors association, yes or no? So we will say film actors association, FAA. We are putting a name, okay? That is film actors association. What is the main objective of film actors association? For the welfare of members. Okay, that is the main objective of any association, for the welfare of members. But how do they get funds? They will collect it from the members, actors. They will collect what? Funds from actors, and they will spend it for the benefit of actors or actresses, whatever it is. So the source of fund is from members, and they will spend it to the benefit of members or for the welfare of members. So this is basically called as principle of mutuality. Principle of mutuality. They are collecting funds from the members and they are spending that fund for the benefit of members. Say they are collected 10 lakhs from members and expended for the benefit of members is 8 lakh. They will collect amount from rich members and they will spend it for the benefit of poor members. So how much is the surplus they have? Surplus 10 minus 8, that is 2 lakhs is their surplus. This is not a taxable profit. Why? They have collected funds from the members and they have expended that funds for the benefit of members only. So it is just like the members are pooling their fund and they are spending that fund for their own benefit. And whatever the balance is normally called as surplus, not profits, and hence this is not taxable. This is not at all taxable in accordance with any provisions of income tax law. Are you all listening? Yeah. So what happens is this 2 lakh is basically considered as surplus, and that particular association need not pay any taxes to the income tax department for that balance funds. Are you with me? But there is one thing. If this association is providing some specific services to members by accepting any consideration, say this particular association is providing, they are providing some service and they are charging it, then whatever profits that they are earning from that particular service shall be fully taxable. Normally, the funds collected by the trade, professional or similar association and it is expended for the benefit of members are not taxable. But if the trade, professional or similar association is doing some specific services to their members by accepting a consideration, then it's altogether a different story. It shall be fully taxable. Are you with me? So that's what section 28 states about income derived by any trade, professional or similar association from specific services rendered to their members shall be fully taxable. I hope it is clear. Now friends, in connection with this point, there is one thing that I should tell you. So that is connected with section 44A. I'll summarize section 44A and tell you. So listen, imagine a situation where say your collection from members, say from members is say 10 lakhs. You have collected 10 lakhs from members and you have expended 14 lakhs for the benefit of members. You have expended how much? 14 lakhs for the benefit of members. Then you will be having deficit. Yes or no? This is normally called as what? Deficit. If surplus is not taxable, then you cannot claim deficit as a loss. Are you with me? If surplus is not taxable, then deficit is not considered as a loss. You need to ignore the deficit. That is the normal custom. Are you with me? But income tax department is so generous. What they are saying is, if you have a taxable profit, say 5 lakhs, You have a taxable profit of 5 lakhs from specific services rendered to your members. You can adjust this deficit from the taxable profit, but there is a condition. What is that condition? Maximum 50% of the profits shall be the adjustable deficit. You can adjust the deficit, but how much is the maximum adjustment? Not 50% of the deficit. It says 50% of the income. So here your income is 5 lakh. 50% of profit means 2,50,000. You need to check whether you have that much deficit. Yes, your deficit is up to 4 lakh. So out of 4 lakh, you can adjust 2,50,000 deficit, and the remaining 2,50,000 shall be the taxable profits. And let me ask you one more doubt. Your total deficit was 4. Out of that 4, you took 2,50,000 and adjusted it with the profits. So how much is the remaining deficit? 1,50,000 is the remaining deficit. Can you carry forward it to the next year? No. You need to ignore the rest of the deficit. So section 44A, what they are saying is, if you have a taxable profit as well as deficit, you can adjust both. But the ceiling limit for adjustment is how much? 50% of the taxable profits, not more than that. This is what the department says. Are you all here? Is that point clear? If you have any excess deficit after the adjustment, you need to ignore the excess deficit, and it is over there in the material. That might be towards the end. There is a section called section 44A that will be towards the end of the material. You can see this section 44A. It is just above the case laws. Section 44A, special provision in the case of a trade, professional or a similar association. Trade, professional or similar association other than associations exempted under section 1023A received any income by way of subscription or otherwise due to the following. Number 1, general services to their members, income that is surplus exempted due to principle of mutuality. Deficit is allowed as a deduction subjected to 50% of total income claimed before deduction under 44A. You can adjust the deficit up to 50% of total income. In case of inadequate or absence of income under Pgbp, such deficit shall be allowed as deduction from income under other heads also. If you don't have any taxable profit from Pgbp, then you can adjust that deficit with the income of other heads as well. While computing income of such association, any allowances of brought forward losses under the Provisions of Income Tax Act must be adjusted first. Before you adjust the deficit, first consider the brought forward losses. Section 44A applies only to such associations which do not distribute their income among their members except in the form of grants, affiliated associations or institutions. So, what they are saying is, this provision is applicable only to those associations which do not distribute their profits to their members. Normally, a trade, professional or similar institution will never distribute their surplus among members. They will keep the surplus for the benefit of their members in future. So, if an association is distributing excess profits among its members, then they cannot claim any of the benefits explained here. Specific services to their members. Income shall be taxable under section 28 and losses, if any, is allowed as a normal business loss. If they have any other income, taxable under IFRS like interest, dividend, etc. If they are receiving interest from bank deposits, that will be taxable under the head IFRS. This is what the department says under section 44A, not AA. It is 44A. I hope it is clear for you. Are you all with me? This is again unimportant section for our final examination, but it is there, which has a connection with your section 28. So that's why I've explained it over here. Coming back to the topic. So we were discussing specific points under section 28. Item number 2 was item number 2 means specific item number 2 was income derived by a trade, professional or similar association from specific services rendered to their members. Moving on to item number 3. What is item number 3? Any salary, any interest, salary, bonus, commission, etc. due to or received by a partner of a firm. Tell me friends, if a working partner is receiving remuneration from his respective partnership firm, is it taxable under the head salary? No. Why? Because there is no employer-employee relationship between the firm and the working partner, and hence that partner have to pay taxes for that remuneration, interest, bonus, etc. under Pgbp. So if any partner receives any interest, remuneration, bonus, commission, etc. from his partnership firm, then that particular receipts are taxable under the head Pgbp, not under the head salary. I hope that also is clear for you. Moving on to the next one, whatever export incentives or similar receipts received or receivable shall be taxable under the head Pgbp. If you are in receipt of any export incentive, what is export incentive? So doing some export. Government, as a part of promoting your export, is giving you some incentive. Whatever incentive that you receive in connection with your export shall be fully taxable under the head Pgbp. Are you with me? You might have heard about profit entitlement passbooks. Have you heard about import entitlements or import entitlement passbooks? Not profit entitlement, import entitlement passbook. Say you are exporting something. For that, say you are exporting fish. To preserve the fish, you require some preservatives. You are importing that preservative for the purpose of exporting fish. When you import some preservative, you need to pay import duty. Yes or no? But what government does, to promote your export, government will say you can import this much liters of preservatives every year without paying any import duty. Or they will reduce the import duty for this much liters of preservative. Are you with me? And you have received that passbook. But you are, manufacturing that preservatives by your own. Say you are manufacturing that particular preservative by your own and you don't require that import entitlement passbook. So what will you do? You will sell it. Whatever profit that you are getting from the sales of that also have to be treated as an export incentive or similar receipt, and it will be taxable under Pgbp. Have you understood the concept? You are an exporter. To promote your export, the government has given you some import entitlements. That means you can import some preservative without paying any duty. But you are manufacturing that preservative by your own. In your own facility, you are manufacturing it. So you don't require that passport. So you can sell it. Whatever profits that you are earning from sales of that also have to be assessed under the head Pgbp because it is a specific item. Item number 3 and item number 4. I hope this much is clear for you. Moving on to item number 5. What is that? Value of any benefit or perquisite, whether convertible into money or not. Very simple, friends. If you are in receipt of any benefit or perquisite which is connected to your business, that have to be assessed under the head Pgbp. Say I am a YouTuber or a vlogger. Okay, Samsung company have given me a latest S25 Ultra. Okay, they told me to use that phone and I can use that particular phone my personal purpose. Then I have to provide a review, positive review. Okay, so I am getting that phone without making any payment. So that value of the phone have to be taxable under the head Pgbp, and there is a TDS for that, 194R. Are you with me? Because most of the people who are in receipt of this benefit were not at all showing it in their return. So the government told the person who gives that particular benefit to deduct TDS. Now it will be under the radar of income tax department and they cannot escape from that particular liability. Are you with me? Every year there is a 2 new TDS provisions. Every annual budget there will be a 2 new TDS provision, and it will, I am sure that it will reach up to 194Z. Okay, I am sure that it will reach up to 194Z. Till now it's not 194Z. So maybe in future, maybe 5 years or 10 years down the line, I am sure that it will reach up to 194Z. So if you are receiving any benefit or perquisite which is connected to your business or profession, that benefit or perquisite have to be mandatorily taxed under the head Pgbp. That's what the department says. And friends, moving on with the item number 6. Very simple. What is that? Fair market value, that means FMV, on conversion of stock in trade to capital asset. Say you are converting your stock in trade to what? Capital asset. What do you mean by conversion of stock in trade to capital asset? Say you are an AC trader. Then AC will be your stock in trade. Due to hot weather, you install one of your ACs in your office. That is called as converting stock into capital asset. Are you with me? So listen, you purchased an AC, say for 20,000 rupees. You purchased an AC for 20,000 rupees. And thereafter, after 2-3 months, you installed it in your office. You installed it in your office. On the date of installation, that AC's fair market value was say 30,000. The fair market value of that particular AC as on date of installation was how much? 30,000. Now there are certain problems in this. Problem number one, once it is installed in your office, now you cannot sell that particular stock. Point number two, once it is installed in your office, it will become your plant and machinery and you have to compute depreciation. So to sort out these issues, what department say, whenever there is a conversion of stock in trade into capital asset, you treat the fair market value as on date of conversion as an income taxable under section 28. It's a notional income. It's a notional income. What do you mean by notional income? It's not a real income because you are not getting anything when you are converting your stock in trade into capital asset. It's just a notional income. So what you need to do is you need to convert that particular, on the date of conversion, you need to show that fair market value of that particular stock in trade as what? A taxable income. Are you all here? So coming back to the point, whenever you are converting your stock in trade to capital asset, the fair market value as on date of conversion have to be treated as what? An income taxable under section 28. Not yet over. You need to do one more thing. The same fair market value you can show as the actual cost of AC. Actual cost of that plant and machinery, 30,000. And you can charge depreciation on this 30,000. The rate of depreciation for AC being a plant and machinery is 15%. And you can charge 15% depreciation on this 30,000. So this is a kind of a permanent fix. When you convert your stock in trade to capital asset, we know that you are not getting any income, but you should show that fair market value of that particular AC as your income taxable under section 28. In the same year, the same amount can be shown as actual cost of that particular capital asset and you can charge depreciation from that value. Are you with me? So it's basically a notional income taxation, point number 6. Point number 7. If you are receiving any non-competing fee or payment receipt for not sharing intangibles. What is non-competing fee? I am about to compete. I'm starting a new academy. Somewhere near to this academy, I'm about to start a new academy. This academy owner visited and they paid me say 10 lakh rupees for not competing. And I'm receiving that 10 lakh rupees not for doing any business. It's a non-compete fee, but it is taxable under Pgbp. If I'm receiving any non-compete fee also, even though that non-compete fee is not a direct business profits, it have to be assessed under the head Pgbp. Are you all here? Similarly, say I have a copyright, say my books, I have a copyright and one academy pays me a lump sum amount not to share the copyright with any others. So we can say payment for exclusivity, payment for not sharing intangibles with anyone else. If I'm receiving an amount, that also have to be assessed under the head Pgbp. Rather than saying payment receipt for not sharing intangibles, it is better to say payment for exclusivity. If you are receiving any lump sum payment for exclusively sharing certain rights with someone, that payment also have to be assessed under the head Pgbp. Point number 8. Any sum received under a keyman insurance policy. What do you mean by keyman insurance policy? Say in your company there is a keyman. If something happens to that particular person, there will be a fall in your profits. There will be a fall in your business. To cope up with that, you have taken an insurance. And something happened to that particular employee and your insurance company is giving you some lump sum payment. That lump sum payment also have to be taxable under the head Pgbp. If something happens to Sundar Pichai, then Google's price will definitely come down. Share price will definitely come down. So Google have already taken a keyman insurance policy. And say something happened to Sundar Pichai and Google is getting a compensation from the insurance company, that compensation have to be processed under the head Pgbp. First of all, Google is not an Indian company. Don't ask me, sir, Google is a US company, then how can they, it is taxable in the hands of Google. I was only communicating the concept. Okay, this is not a real example. I was only communicating the concept. Say instead of Google, say Reliance Industries. Instead of Sundar Pichai, say Mukesh Ambani or whatever it is. Okay, yeah. So coming back to the point. So any sum received under a keyman insurance policy, but in certain policy, the compensation is given to the employee. If the employee himself is getting the compensation, then it have to be taxable under the head salary. In certain cases, if there is a death or something like that, then the compensation will be given to the legal heirs of the employees. If the compensation is given to the legal heir of the employees, then it will be taxable under IFRS. So here, the compensation will be taxable under PGBP if it is received by the employer. If the employer is receiving the compensation only, it will be taxable under the head PGBP. Otherwise, you need to think about the other heads. Are you all here? Super. Moving on. What is next? Item number 9. Any amount received on sale or discarding of a capital asset where whole of the amount is already allowed as deduction under section 35 AD. What is that? Any amount received on sale or discarding of a capital asset. Say for example, have you heard about section 35 AD? Deduction for specified businesses. We will study section 35 AD in detail when we move forward in this particular chapter. But for the time being, section 35 AD says that if you are a specified business or if you are a notified business, you have an advantage. What is the advantage? You can claim 100% deduction for your capital expenditure. Whatever capital expenditure that you have, you can claim a deduction, and that too 100% deduction. Say for example, normally a hospital with 100 patient beds are considered as a specified business under section 35 AD. Say this hospital constructed a building for 10 lakhs. They constructed a building for what value? 10 lakhs. Are you all here? Now, they can claim the entire cost of this building as a deduction under 35 AD. They don't have to capitalize it and they don't have to claim any depreciation. Rather, they can charge that entire 10 lakhs as a deduction in a go while computing their business profits. Are you all here? Accordingly, they have claimed deduction for that entire 10 lakh. Say this happened in year 1. Say in year 3, they sold this building. They sold this building and they got 8 lakh at the time of sales. They sold the building and they got how much? 8 lakh. This entire 8 lakh have to be taxable under section 28. Why? Because the entire cost of the building, once you have charged as a deduction from your taxable profits, now you are getting back some amount where you have claimed a deduction. The entire recovery shall be fully taxable under the head PGBP under section 28. Are you with me? So, in the case of an asset where the entire cost is already allowed as a deduction under 35 AD, and now you are selling or discarding that particular asset and you are getting some amount from that particular asset back, whatever amount that you got from that asset have to be assessed under the head PGBP. You know the reason. What is the reason? Already I have claimed 100% deduction for the entire cost of that particular asset. Now I am getting some amount at the time of sale. It is just like a recovery of the expenses. So you have to show it as an income under PGBP. Any amount received on sale or discarding of a capital asset where whole of the amount is already allowed as a deduction under 35 AD. I hope it is clear for you. Moving on to the next one. What is that? This is the highlight. This is the hero. What is that? Income from speculative transaction. They are not saying business. What is that? Income from speculative transaction. What is the difference between speculative transaction and speculative business? A transaction will be considered as business if it is a recurring. Yes or no? Say I am selling my house property. Is it my business? No. I am selling different house properties. I am constructing house property and I am selling it. Then it will become my business. So the recurrence is the factor to decide whether a transaction is business or not. Here they are not saying speculative business. They are saying speculative transaction. If you are entering into any speculative transaction, irrespective of the period of frequency of that particular transaction, you need to show that income from that transaction as an income chargeable under PGBP. Are you with me? That single sentence have lot of meanings. Whatever income or loss that you are incurring in connection with speculative transaction, irrespective of the frequency of the speculative transaction, have to be processed under the head PGBP. So income from speculative transaction to be treated as a separate business, and you are not supposed to mix it up with your existing business. You need to show it as a separate business profit or a separate business loss. Are you all here? Now there is a $1 million question. What is the speculative transaction? That you should know. So what is speculative transaction? The income tax department gives a definition for that. Means a transaction which a contract for purchase of sale of any commodity, including stocks and shares, is periodically or ultimately settled otherwise than by way of actual delivery or transfer of commodity or scrips. That means you are purchasing something or you are selling something without taking delivery. You are purchasing something or you are selling something without taking actual delivery. So it is just like when you are purchasing something or you are selling something without taking actual delivery. That transaction can be called as a speculative transaction. Example, intraday trading. A normal share purchase and sale is not a speculative transaction because you are actually taking delivery of the shares. But intraday transaction is a classic example for speculative transaction. Why? Because you are not purchasing anything, you are not selling anything. You are only dealing with the margins. It is a position. In the morning, it's called short sale, or you will purchase it. In the evening, before the market closes, you will take the opposite position. And whatever margins that you earn is not on account of purchase and sale. It is on account of positions. Are you with me? These kinds of transactions are normally called as what? Speculative transaction. Best example, intraday trading. Now, an income tax department also says one thing. If you are doing some intraday trading, irrespective of the frequency of the trading, whatever income that you have earned have to be treated as your business income. Whatever loss that you are incurred have to be treated as your business loss. Are you with me? Is that point clear? Whatever income or loss that you are incurring in relation to speculative transactions have to be processed under the head PGBP. That's it. Now, department also says one more thing. Transactions not deemed to be speculative transaction. These following 1, 2, 3, 4 and 5, these transactions are a kind of a negative list. These are actually in the nature of speculative transaction. But department say these are not considered as speculative transaction. Let's understand which all other items. Number 1, hedging contract in respect of raw materials or merchandise. You know what is hedging? You might have studied it in your AFM or SFM, whatever it is. Hedging means, say there is a possibility of price hike for your raw material. Then you will enter a contract with some supplier for purchasing your raw material at a reduced price in future. And you might not take the delivery in future, rather you will only tell him to settle the difference. So if you are not actually taking delivery of a hedging contract which is connected with your raw material, that is never considered as a speculative transaction. It is actually speculative in character, but not considered as a speculative transaction. Automatically the raw material price will get adjusted. Say for example, you are a jeweler. After 1 year, you are sure that say 1 kilo or 1 gram of gold will have a cost of say rupees 10,000. I don't know what is the current gold price. 1 gram of gold, what is the price? 7,800. Okay, perfect. Say 1 gram of gold in next year, you are so sure that it will be 10,000 rupees. So you are entering into a hedging contract with some person for buying gold for 8,000 rupees in next year. Okay. And this is you, and your expectation is 1 gram of gold will cost 10,000 next year. And the other counterparty who is entering into hedging contract with you, his expectation is gold price will come down. Next year's gold price will be only say 5,000 rupees. This is his expectation. Okay, so these are actually done based on expectation of two different parties. Are you all here? Now, listen. Say in future next year, the gold price was exactly 10,000. My vision was right. It was exactly 10,000. So I will never tell my counterparty to supply 1 gram of gold. Rather, what I will tell is, You need to adjust the margin. The future market price is 10,000. You agreed to give me 1 gram of gold for 8,000. You do one thing, you pay me 2,000 rupees. I will spend 8,000 from my pocket to buy 1 gram of gold from outside market. Are you with me? If I'm a jeweler and I'm entering into such transaction, then you tell me what is the price of 1 gram of gold for me? 8,000. That 2,000 is automatically got adjusted in the purchase price of the gold. You don't need to show it as your separate business profit or separate business loss. That is why they provided it as a negative list to speculative transaction. Have you understood the concept? So if you are entering into a hedging contract in respect of a raw materials or merchandise, negative list. Number 2, hedging contract in respect of stock and shares by a dealer or investor. Instead of gold, say you are a full-time trader. You have done the hedging contract for your shares. Concept is same. Whatever profits or losses that you are incurring have to be adjusted with your normal business profit or normal business loss. It need not be shown as a separate speculative business. Third one, forward contract, arbitrage, etc. Have you heard about arbitrage? In your AFM or SFM, spot price, future price, there will be a difference. To back that difference, you will deal in bulk. If you are doing it, it is basically a speculative character. But income tax department is not considering forward contracts, arbitrage, etc. as speculative transaction. That will be considered as a normal transaction only. Point number 4, trading in derivatives, futures, options, etc. You are buying and selling futures or options. 100% speculative character. But department say not considered as a speculative transaction. It will be considered as a normal business transaction only. Likewise, trading in commodity derivatives. Again, 100% speculative character. But income tax department say no. It will be considered as a normal business activity only. Now, what is the speciality? The main speciality is if we have a loss from speculative business, that loss can be adjusted only with profits from speculative business. That is a highlight over here. That's why department is saying you to separately account for the speculative transaction. Are you with me? Because according to the SEBI's statistics and data, almost around 70, 75 to 80% people are making loss in speculative transaction. Only the remaining are only making some profits. I think it is more, somewhere near to 90%. So income tax department say, we know that you are gonna end up in a loss. Don't show it as your normal business loss. You treat it as your separate business loss. And you have to adjust those speculative loss only with your speculative business profits. So that's why if you have some loss in trading of options and futures, you can show it as your normal business loss and you can adjust with your normal business profits once they have tested this in an exam as an adjustment. Options and futures loss. Options and futures is basically derivatives. And whatever loss that you are incurring will be considered as a normal business loss only, not speculative transaction because it comes under the negative list. So what you can do? You can adjust it with your normal business profits. Are you all here? Is that point clear? Super. So that is what is speculative transaction. Now friends, listen. There is another last thing. This is technically not section 28, but it is again an income chargeable under Pgbp. That's why I have classified it under 28. It is basically technically section 9b. This we will study in which chapter? Capital gains chapter. So profit on transfer of stock in trade by a partnership firm, AOP or BOI, in connection with the dissolution or reconstitution to a partner or member. In simple way, I will tell you this. For the time being, this basic understanding is more than enough, and we will have a detailed coverage on this topic when we discuss capital gains. Imagine we are a partnership firm. You are retiring. Today you are retiring. So we can call it as a reconstitution of partnership firm. When you are retiring, I must settle your accounts. Yes or no? Are you all listening? When you are retiring, I must actually settle your accounts. Say, when you are retiring, I am supposed to pay you 10 lakh rupees. I am supposed to pay you what? 10 lakh rupees. So instead of giving you 10 lakh rupees, I am giving you stock, which I purchased for 6 lakhs. I am giving you what? Some stock, which have a market value of somewhere near to 10 lakh, which I purchase for 6 lakhs. I'm giving you the stock and you're saying enough. I don't want 10 lakh rupees money. I only need this stock. So the partner, retiring partner, took the stock, said, okay, tata, bye bye. So you think about from the perspective of partnership firm. The partnership firm is indirectly getting 10 lakh rupees for their stock in trade. Yes or no? The purchase price of the stock in trade was only 6 lakh. Now they are supposed to give 10 lakh. Instead of giving 10, they are giving stock having a value of only 6 lakh. So they are indirectly getting a margin of 4 lakh rupees on their stock in trade, which is given to a retiring partner. This 4 lakh shall be taxable under section 9B under Pgbp. This is the concept. Whenever a partnership firm, AOP or BOI, is giving stock in trade at profit to their retiring or member who is dead, that the profit that they are earning through that process shall be taxable under Pgbp. We will be solving some questions as well as we'll be handling detailed example in capital gain. Okay, yes. Capital gain and this point have a connection that we will discuss in capital gains. So these are the main points under section 28, and there is one more important point. I'm not saying important, one more point which came as a part of July 2024 annual budget. Normally it is February. So automatically when I am about to say annual budget, February will come. Okay. So the last year budget was in July. So in July 2024 annual budget, they've introduced one more thing. Listen, very simple. Say, I am a person having house property. I'm a person what? Having 5 house properties. What? 5 house properties. I'm renting all the 5 house properties. I'm renting all the 5 house properties. And I'm saying that it is my business. And I'm saying that it is my business. So normally, before this amendment, this contention was accepted by the department. And the department will say that, okay, you do one thing. You show that rental income as your income from business. Then you claim all the expenses. Are you with me? Now, there is an alternate possibility. I have 5 house properties and I'm renting all the house properties. I can also say that these are incomes taxable under house property because I'm not treating it as my business. If I'm saying that it is under house property, then department will allow the contention. Okay, you show the income under house property, then you claim standard deduction and the other expenses. So what normally the client do is, the client will think about his actual expenses. If his actual expense is high, then he will say that renting of house property is Pgbp. Because in house property, the maximum deduction that you can claim is municipal taxes, 30% standard deduction, interest on loan, bus. If your expense is less, then you will say house property. So why? Because you can claim standard deduction every year 30%. This was a headache for the department. And there were a lot of case laws also. Chennai house property, there is a case law. The High Court says you have to accept the contention of the assessee. If he says business, it is business. If he says house property, it is house property. Department was got fed up. So they brought in an amendment. Say you are letting out a residential house property, even as a business, it have to be assessed under house property. In future, if you are letting out residential house property, even if it does as a business, you have to treat it under house property. Don't bring it under Pgbp. Income from letting out of residential house or part of house by the owner is chargeable to tax under income from house property, not under Pgbp. They standardized it. It is only residential properties. If you are letting out commercial property, maybe you can say it as your business or as your house property income according to your wish. But if you are letting out residential property, automatically under house property. Irrespective of the frequency of the transaction, you are not supposed to show it as your Pgbp income. That's what the department says. Are you all here? So that is all about section 28, that is charging section under Pgbp. I hope section 28 is clear for you. So friends, let's start today's discussion. Yesterday, we were discussing about section 28 and now we have another income section to cover in Pgbp, that is section 41. So friends, we are about to discuss section 41 right now, that is deemed business income. So what do you mean by deemed business income? The following things which we are about to discuss, whether it is your direct business income or not, you have to assess it under Pgbp. We call it as what? Deemed business income or deemed business profits. Okay. So what is item number 1 under this deemed business profits? That is expenditure or a loss or a trading liability incurred earlier allowed as a reduction if subsequently waived. So I'll read that point again. Listen, what is that? Expenditure, or it can be a loss, or it can be a trading liability which is incurred earlier allowed as deduction if subsequently waived. What do you mean by this? I'll give you an example for this. Listen, say in the year say 2022-23, you purchased some goods on credit. Okay, you purchased certain goods on credit. It say 10 lakh rupees was actually payable. You follow mercantile system of accounting and hence you claim this 10 lakhs as a deduction. In which year? In 22-23. In 2024-25, there was some cash crunch for you. There was some kind of liquidity issues for you. So you are not able to make that payment of 10 lakh. So you had a word with your creditor and the creditor told you to not to make the payment. Your creditor waived off that entire 10 lakh rupees. So that happened in the year 2024-25. Now you imagine if the creditor waives that entire 10 lakh, so you have already claimed that 10 lakh as an expenditure in the year 22-23. In the year 24-25, you are not supposed to make that 10 lakh rupees to that respective creditor. So you are getting an advantage. You are not expended something, but you have already claimed it as an expenditure. So you need to reverse the effect. Yes or no? So what income tax department say? You claimed it as a deduction in the year 22-23, rupees 10 lakh. To balance the effect, you do one thing, you show this 10 lakhs as your income under deemed business income under section 41. In accountancy, there is a thing called reversal entry. In income tax, there is nothing called an entry. Okay, so what you need to do? If you have already claimed it as a deduction, now you reverse the effect. To reverse the effect, what you should do? You should consider it as your income so that the effect will get nullified. This is what the department say. That's what they are saying. It is a deemed business income. You are not receiving any income, but it should be shown as income to balance the effect. Are you all with me? So this is what the first item under section 41. We'll read that again. It can be an expenditure or a loss, or it can be a trading liability which is incurred earlier allowed as deduction. What is this earlier allowed as deduction? Maybe in some past previous year you have already claimed it as your deduction. If subsequently waived, that means in this year that particular creditor have waived off this right. So such amount have to be treated as your deemed business income. Moving on to the second point, that is balancing charge. We will study balancing charge when we discuss section 32 depreciation. Are you with me? So for the time being, I am not explaining what is balancing charge. We will explain or we will have a detailed discussion of our balancing charge when we discuss section 32, especially SLM method of depreciation. So when we discuss that topic, I will cover what is balancing charge. But for the time being, balancing charge also have to be treated as an income or a deemed business profit taxable under section 41. Moving on to item number 3, proceeds from sale of capital asset acquired for scientific research without using for such purposes. Again, we will cover this topic when we discuss under section 35, scientific research asset. We will discuss section 35 in detail when we move on. During that time, I will explain what exactly is the meaning of that particular note. Moving on to the next one, recovery of bad debts already allowed as deduction. What do you mean by bad debts? A debt which is not recoverable can be called as what? Bad debts. You have a debt. You have done a credit sale. There is a debtor and the debtor is not going to make you the payment. So that debtor have become bad. Now what you need to do? You need to write off that debt in your books of accounts and claim it as a deduction. Are you with me?
Yes, sir.
Now listen, there was a debtor who was supposed to make you a payment of rupees 1 lakh. Okay, there was a debtor. So you are supposed to make you a payment of how much? Rupees 1 lakh. You called him and he told that I have no plans to make you that payment of rupees 1 lakh. Forget about the payment. So what you did? You have written off this particular 1 lakh in your books of accounts and claimed it as a deduction. You can claim it as a deduction under section 36. We will discuss section 36, other specified deductions, when we move on. Are you with me? So, if a debt is not recoverable, you will treat it as your bad debt and you can write it off in your books of accounts, and that amount written off will be treated as your expenditure, as your deduction, which we will cover under section 36. So, you have already treated it as non-recoverable. Thereafter, the debtor came in and paid that entire 1 lakh. So, now we can say that there is a recovery of bad debt. What is recovery of bad debt? You have already treated it as bad debt and you have written it off from your books of accounts. Now the debtor came back and made you the entire payment. So what you need to do? You need to show it as your income. So that's what they are saying. Recovery of bad debts already allowed as deduction. If you have already claimed a bad debt as a deduction and subsequently it is recovered, that amount recovered have to be an income taxable under section 41. We call it as deemed business profits. Are you with me? Good. Moving on to the next item, amount withdrawn from special reserve which has initially allowed as deduction under section 36 subsection 1 clause number 8. We will discuss this under 36 subsection 1 clause number 8. Whatever amount that you are withdrawing from a special reserve also have to be taxable under section 41. And what is the last one? If you are getting any income from any discontinued business or profession, that also have to be taxable as an income under section 41. What do you mean by that? You were running a business. Say it was at loss. So you discontinued that business. After discontinuation also you got some payment. Say there was some debts at the time of discontinuation. After discontinuation that debtor came to you and made the payment. Or there is something, some recovery. Okay, you have claimed it as bad debt. Thereafter, after discontinuation, that debtor came in and made the payment. So whatever income that you are getting in relation to a discontinued business profession also have to be shown as an income taxable under section 41. Just like arrears of rent in house property. When you are getting some arrears of rent in relation to house property, whether you own that house property or not is not a factor. In the year of recovery, you have to show it as your income. This is something like that. If you are getting any income which is connected to your discontinued business or profession, that also have to be processed under Pgbp under section 41. I hope that also was clear for you. So these are the main items under section 41. Now there is actually a note. This is, we can call it as important. Okay, this is basically case law, but this is actually very important. It has been tested, I think, twice or thrice, both in CMA final as well as CA final. This has been tested. So let's understand what exactly is this note. If sales tax paid, claimed as a deduction, and later the same has refunded back to the assessee, then it will be taxable as revenue receipt, and the same will be taxable under section 41 subsection 1. However, if assessee can avail it as a deduction, if he has paid the refund amount to his customers. It's actually a case law. That is Thirumal Swami Naidu and Sons, which is cited by the Supreme Court in the year 1998. So let's understand what exactly is that particular case law. It was a very old case law. To make you understand the concept, I am making use of GST. It was actually collected sales tax. At that time, it was sales tax. Now I am making an example by saying it as GST. Okay, so listen. Say JK Limited is a company. They sold some goods to customers and collected GST. And collected GST of say rupees 10 lakh. And they made this payment to the government. They made this payment to the government. Okay. Thereafter, JK Limited filed a case. JK Limited filed a case in the High Court and they said that this amount of GST is huge. Say there is a change in the rates. Okay. JK Limited belief is GST rate is 12%, but they have collected say 18% and they paid it to government. Thereafter, they filed a case stating that this 18% rate is not right. It should be 12%. And JK Limited won the case. And they got a refund of GST. Say they got 6 lakh rupees refund. They got what? 6 lakhs rupees of GST as a refund from the government on a direction given by the court. Now they are getting this 6 lakhs. Yes or no? They have to distribute this 6 lakhs to the customers because this GST element is actually collected from the customer. So if you're getting this GST as a refund, then you should mandatorily distribute it to your customers. Are you all here? So what department say? If you are distributing this entire 6 lakhs, or rather we can say whenever you're getting this refund have to be treated as an income taxable under section 41. You have to treat it as your deemed business income. Whenever you distribute this 6 lakhs to your customers, you can claim it as a deduction. So what does that mean? Whenever you are getting a refund, that have to be your income, and whenever you distribute correctly to your customers, you can claim it as a deduction. That simply means if you are not distributing it to your customers, that 6 lakh will become your income. Are you with me? If you are keeping that 6 lakhs with you, you are not distributing it to your customers, then that 6 lakhs will become your income taxable under section 41. And I can create a possibility. He got a refund in the year 2024-25. He got the refund of rupees 6 lakh in the year 2024-25. Then their entire refund will become his income under section 41. He distributed this to the customers in the year 25-26. Then he can claim 6 lakh as a deduction from profits in the year 25-26. He can definitely claim it as a deduction as well. No problem. If you are not distributing that particular refund this year, then this year that will become your income. Next year, if you are distributing it, next year you can claim that same amount as a deduction. Are you all here? So that was the ultimate concept which is there in that particular case law. So if you're getting a sales tax or a GST refund, you need to mandatorily distribute those particular refund to your customers. If you are not distributing it to your customers, then we will treat it as your income. Whenever you distribute it in future, we can claim it as your deduction. I hope it is clear for you. Moving on. And what is next point? So this is all about section 41. So 41 is, I'm not saying it as an important section. 41 is not that important, but still it will be useful for us. It will be useful. Maybe institute may come up with some kind of adjustment in a lengthy question so that we can make use of section 41 to crack that particular adjustment. So I hope it is clear. So last session, I hope you remember, we have explained the importance of section 145, that is a method of accounting. That is, income chargeable under Pgbp and IFIs is to be computed in accordance with either cash system or mercantile system of accounting regularly employed by the assessee, subject to notified ICDS by the government. So the profits under Pgbp will be based on either cash system of accounting or mercantile system of accounting. And while computing the profits, you need to mandatorily follow notified ICDS as well. This is what the department says. Again, a simple point. So that was 145, method of accounting. Moving on to the next section, friends. Listen, section 29 is just like a map. What is map? It will guide you. Yes or no? So section 29, what they are saying is how to compute income from the business or profession. Or rather we can say, what exactly are the next set of sections in Pgbp? So according to 29, section 30 to 37 is what? Admissible deductions. What is admissible deductions? Section 28 was income. 41 was deemed income. Now 30 to 37 are the deductions that you can claim from your taxable income. You can claim deductions in accordance with section 30 to 37. Then section 40 series is inadmissible deductions. What do you mean by inadmissible deductions? Just like disallowances. Disallowances. Expenses that are not allowed as deduction is called as inadmissible deduction. Then section 48, expenses or payments not deductible in certain circumstances. What does that mean? In certain circumstances, you are not supposed to claim certain expenses as a deduction. Normally, it is allowable as deduction. But in certain circumstances, it is not allowed as deduction. Example, cash paid over and above 10,000 in a day for an expenditure. say printing and stationery expenses 25,000 you have paid in cash. Normally printing and stationery expenses are deductible expenditure. But since you paid it in cash, you cannot claim it as a deduction. So that's what I said. Expenses are payment not deductible in certain circumstances. Two sections are there. 40A2 excessive payments to relatives and 40A3 payment more than 10,000 made in a single day, otherwise than by way of account pay, check account pay, bank draft, TCS and prescribed electronic modes we will cover later. Then the next one, profits chargeable to tax, that we have already covered section 41. Then other provisions. Other provisions means section 44AA, maintenance of books of accounts. 44AB, tax audit. 44AD, presumptive taxation. 44ADA, presumptive taxation for notified professionals. Then 44AE, presumptive taxation for goods transporters. So likewise, there are other sections as well. Now there is some presumptive taxation for non-residents also, but we will cover that topic in NR taxation. Okay, so there are certain presumptive taxation for non-residents also that we will cover in which chapter? NR taxation. So these are the things that we are about to deal in the chapter PGBP when we move on. So without wasting time, let's straight away start with the deductions. Without wasting time, let's start with what, friends? Deductions. So deductions are from section 30 to 37. And the first section in this class is section 30. What is section 30? Deduction on rent, rates, repairs and insurance for building. So listen friends, it's a pretty simple section. Say you have a building which is basically used for your business or profession, either as an owner or as a tenant. Say you have a building, you are running your business in that particular building, or you are running that profession in your particular building. This building related 4 types of costs can be claimed as a deduction under section 30. Are you with me? So 4 types of cost. So 4 types of cost that are incurred in connection with your building, which is basically used for your business or profession, is allowed as a deduction under section 30. So friends, listen, when you discuss or when you learn deductions, one thing you have to be very careful. See, there are certain characteristics for this deductions. Okay, I've already told you that section 30 to 37 are the deductions. Out of the deductions, section 30 to 36 we call it as specific deductions. Specific deductions. And section 37 is what? General deduction. Tell me friends, what do you mean by specific deductions? What exactly is allowed as deduction? Is there any ceiling limit, etc. have been specifically provided under section 30 to 36. There is no point of any confusion. What exactly is allowed as deduction have been clearly mentioned from section 30 to 36. When it comes to 37, all other expenses which are actually connected with your business or profession is allowed as deduction under section 37. That's why we call it as general deductions. So when we discuss section 30 to 36, only those items which are specifically covered under the respective section are allowed as deduction. Nothing else. You cannot add anything. You cannot improvise that particular section. You are not supposed to add anything else. Whatever they have listed from 30 to 36, you can claim it as a deduction. Whatever other expenses which are connected with are allowed as a deduction only under 37. So from 30 to 36, the first section is section 30. And how many costs are covered under section 30? 4 types of costs are covered under section 30, which are connected with your building, which is used for your business or profession. Which are the 4 types of cost? Number 1, rent of a building. You have taken a building on rent, that the rent you pay is allowed as a deduction, no doubt. Second one, current repair not in the nature of capital expenditure. What is current repair? Say that building's window glass got broken. You need to fix it. then only say it's an AC building, it's an air conditioned building, you need to fix the glass, then only you will be able to switch on the AC properly. Yes or no? Say all those expenditure that you incur to bring back that particular building to its normal usage condition is said to be what? Current repairs. All those expenditure that a person incur to bring back a particular building to its normal condition can be called as a current repair. And there can be one more expenditure, that is capital expenditure. You tell me, what is capital expenditure? Whatever expenditure that you incur and which result in increase in capacity, volume, usage, life, etc. is called as what? Capital expenditures. Say for example, you have expanded that building. That increases the capacity of that particular building. Are you with me? So whatever expenditure that result in increase in capacity, volume, usage, life, etc. of a capital asset is said to be what? Capital expenditure. So whatever capital expenditure you are incurring in relation to building is never allowed as a deduction under 31. You can capitalize it and charge depreciation. That's it. Only current repairs are allowed as a deduction under section 30. So current repair not in the nature of capital expenditure. Then what's next? Rates and taxes. Say if you own a building, you need to pay what? Property taxes, sewerage taxes, and the other taxes in connection with the building to the local authority, either to the panchayat, municipality or corporation, whatever it is. Whatever taxes and rates that you are paying to that local authority is again allowed as a deduction under section 30, because you are using that particular building for your business or profession. It will not be covered under house property. If you are using a particular building for your business or profession, that will come under Pgbp. Whatever rates and taxes that you pay is again allowed as a deduction under section 30. And what is the last one? You have taken an insurance for the benefit of a building. You have taken insurance, say earthquake insurance, fire insurance, etc. You have took. That premium that you pay in relation to that particular building insurance is allowed as a deduction. So most people usually takes insurance for building by paying a premium. If you are taking an insurance and you are paying a premium, that premium paid is again allowed as a deduction under section 30. So there are 4 things that are allowed as a deduction under section 30. Which are the 4 things? Rent, current repair, rates and taxes, insurance premium. So all these 4 expenditure that you incur in connection with your building, either as an owner or as a tenant, doesn't matter, is allowed as a deduction while computing your taxable business profits. This is what the department says. I hope it is clear. These are simple sections. So we can straight away discuss and finish it off. Moving on to the next one, section 31. And you tell me, what is section 31? Repairs and insurance of machinery, plant and furniture. Say you are using any plant and machinery or furniture. You are using either a plant and machinery or a furniture for your business or profession. You are using a plant and machinery or a furniture for your business or profession. Whatever cost that you incur, which are in the nature of current repair and insurance expenses, are allowed as a reduction under section 31. Are you all here? So let's have a detailed discussion over that point. Deduction is allowable for number 1, current repair. Number 2, insurance expenses incurred on machinery, plant and furniture in computing the income from business or profession. So let me ask you one simple doubt. You are using a plant and machinery. Do you have to pay any rates and taxes to the municipality for using a plant and machinery? No. Municipality normally charges a tax only on the building properties, not on plant and machinery, furniture, etc. So rates and taxes will never come under section 31. Now let me ask you one more doubt. You can take a plant and machinery on rent and use it for your business or profession. Yes or no? That is quite possible. You don't have to own a plant and machinery always. You can take a plant and machinery on rent. Now my question is, if you are taking a plant and machinery on rent, can you claim that rent paid as a deduction under section 31? The answer is no. You cannot claim that rent paid as a deduction under section 31. Why? Because section 30 to 36 is specific. Only those items which are covered under 30 to 36 is allowed as a deduction under the respective sections. So if you are incurring a rent which is connected with your business or profession, or which is connected with your plant and machinery or furniture, which is used for your business or profession, then that rent is allowed as a deduction under section 37. If you are paying any rent which is connected with your business or profession, that is allowed as a reduction under section 37, not under section 31. I hope it is clear. So the point is very simple. 30 to 36 are specific deductions. So what all are the items covered under 30 to 36? Only those items you can claim as a deduction under the respective sections. Moving on. Now the next question is, say I am using a building, plant and machinery or furniture, but not fully for my business purpose. Say I have a building and 2/3 is used for my business and 1/3 is used for my personal purpose. Say there is a building, 2/3 portion of that particular building is used for my business purpose, or rather than saying 2/3 and all, I'll say 70%. 70% of the building is used for my business and 30% is used for my personal purpose, and I've paid rates and taxes for that particular building. Now what will happen to the rates and taxes? Can I claim that the entire rates and taxes as a deduction under section 30? No. Only 70% of the rates and taxes are allowed as a deduction under section 30. Likewise, whatever expenditure that are covered under section 30 to 31, if you are not using that building or plant and machinery or that furniture for your business alone, only the proportionate usage for its business allowed as deduction. So on the entire expenditure you apply the proportion, then you claim that proportionate expenditure only as a deduction if you are not using it fully for your business. Are you with me? So let's read the theory. Note, building, plant and machinery or furniture as above are used partly for business and partly for other purposes. Only a proportionate part of the expenses attributable to that part of purpose of business will be allowed as a deduction according to section 38 subsection 2. If you are not using a particular building or a plant and machinery or a furniture wholly for your business purpose, only that proportionate part that you incur or that you have actually incurred for your business or profession are allowed as a deduction. The rest you have to ignore. I hope it is clear and it is purely logical as well. So these are the three main deductions, or not three, two main deductions under 30 and 31. Now we are about to discuss another huge deduction, that is section 32, depreciation. It's a huge area, lengthy area, and we have a lot of things to cover under section 32. So let's understand what exactly is this section 32, depreciation. First of all, you might have learned depreciation in your accountancy. Okay. In accountancy and in income tax, only the name is similar, depreciation. The method of computation and the other related concepts are entirely different. Are you with me? So don't use your accounting knowledge right now when you study income tax depreciation. So accounting knowledge is good for accountancy. You don't use that for income tax, because here the computation is different, the way it is treated is different, conditions are different, everything is actually different. So let's understand depreciation in a very detailed manner. First of all, the first thing that you should know is depreciation is a compulsory deduction. What do you mean by compulsory deduction? It's actually a comedy. Whether assessee have claimed depreciation in return or not, every year income tax department, when they assess the income, they have to provide for depreciation. It's a compulsory deduction. Every assessee who have a capital expenditure must be given with a depreciation deduction. In whatsoever manner you have to compute it. Even if assessee have failed to consider that in their return of income, department themselves have to take the initiative and they themselves have to provide for the depreciation. This is what the act says. We call it as explanation 5 to section 32. Depreciation is a mandatory deduction. Now, for claiming depreciation, there are certain conditions to be satisfied. You cannot simply capitalize your capital expenditure and charge depreciation. There are certain conditions that are required to be satisfied. Let's understand the conditions one by one. What is condition number 1? asset must belong to certain specified categories. If you have an asset and that asset is covered under any specified categories of assets as per the IT Act, then only you can claim depreciation. Are you with me? So, if you have an asset and that asset is already covered under a specified category, then only you can claim depreciation. Otherwise, you cannot claim any depreciation. Now, which all are the categories that are there in income tax? We can say either 4 or 5, both are right. Okay, we can say either 4 or 5, both are right. So, basically what I am saying is there are 4 main categories are there. Number 1, building. Number 2, intangibles. Number 3, furniture. Number 4, ships. And number 5, plant and machinery. And there is a thing that ships and plant and machinery are treated as 1 as well as 2. According to the original depreciation schedule, ships are different, plant and machinery are also different. So that's why I said 5 categories. Number 1, building. Number 2, intangibles. Number 3, furniture. Number 4, ships. And number 5, plant and machinery. Every main category have a lot of subcategories. For example, computer will come under plant and machinery. Books will come under plant and machinery. Motor car will come under plant and machinery. Fittings will come under furniture and fittings. Are you with me? So each and every main category actually have some subcategories. But whatever asset that you own should come under any of this 5 category. Then only you can charge what? Depreciation. Now let me give you one example of an asset where it will not be coming under any of those categories. Say land. Land will not come under any of this category and hence you cannot claim any depreciation on land. In accountancy also you cannot charge any depreciation on land because land value never depreciates. That's what the department says or the standard says. Land is land always, whether you do business or not, land value never depreciates. So that was the point. Now what is condition number 2? Can you read condition number 2? Asset should be owned either partially or wholly by the assessee. Assessee should be the owner of an asset to claim what? Depreciation on an asset. Assessee should what? Own an asset. Then only he can claim or he can charge depreciation over the value of the asset. Again, one more thing is there. Ownership does not mean legal ownership alone. It can be beneficial ownership as well. What is beneficial ownership? I'll give you an example for beneficial ownership. Okay. Say a partnership firm bought a car. Okay. A partnership firm bought a car. That car is in the name of a partner. The car is in the name of a partner. In the registration certificate and all, that car is in the name of a partner. But partnership firm repays the EMI. The partnership firm paid the road tax. The partnership firm is paying the insurance. And the partnership firm is taking care of its repairs. And the partnership firm is actually using that car for their business. But that car is in the name of the partner. So the question is, can the partnership firm claim depreciation over the value of the car? The answer is yes. Definitely yes. Because it is not mandatory that the partnership firm should be the legal owner of that particular asset. They can be a beneficial owner as well. What is beneficial owner? I paid for the asset and I am using that particular asset. That asset is in someone else's name. No problem. I can definitely charge what? Depreciation. Are you with me? But there should be some justifiable reason. Okay, that person whose name is there as an owner, there should be a justifiable reason. Say husband have an asset and it is in the name of wife. Husband is using that particular asset, no problem. Husband can claim what? Depreciation. Are you with me? So here, ownership also includes beneficial ownership. Moving on to the third one, what is the third condition? The asset should be actually used in the relevant previous year for assessee's business. To claim depreciation, you have to use that particular asset in the relevant previous year for your business. Are you with me? So, 3 major conditions are there for claiming depreciation. You tell me which are the conditions. Number 1. assets should come under any specified categories. Assessee should be the owner of the asset, and assessee should use that asset in the relevant previous year for his business or profession. Okay, here we have written assessee's business, or we can say profession, whatever it is. So these are the three main conditions for charging what? Depreciation under section 32. Now, not yet over. There are certain other things that you should know before we start computing the depreciation. In accountancy, how do you claim depreciation? It is totally based on the number of days of use. Yes or no? If an asset is purchased and used for 100 days, then you will claim proportionate depreciation for 100 days. If an asset is sold after using it for 40 days, then you will claim proportionate depreciation for that 40 days. This is how you compute depreciation in accountancy. In Income Tax Act, no, it is not based on the number of days of use. There is a concept called either full or half. In accountancy, it is based on the number of days of use, but in income tax, the concept is called as either full or half. What is that? Very simple. I'll make it very simple. Listen. If you have an asset, and you use that particular asset only for 1 day. You use that particular asset for your business only for how many days? 1 day. You can charge what? Full depreciation over that asset. This statement have only one exception. What is that exception? In the year of purchase, you are put to use an asset for less than 180 days. Then only 50% of the normal rate is allowed as deduction. Listen, what is the theory? For a normal asset, if you have purchased that asset and put to use that asset for less than 180 days in the year of purchase, then only 50% will come in. In the next year, you have used that particular asset only for 1 day, but you can still claim 100% depreciation. 100% means whatever the rate of depreciation is. If it is 15% depreciation you can charge. In the year of purchase, if an asset is put to use for less than 180 days, you can charge only 50% of the normal rate of depreciation as a deduction in accordance with section 32. Are you all with me? That is what is the first point is all about, either half or full. What are they saying? If in the year of acquisition, an asset is only used for less than 180 days, depreciation shall be allowed at 50% of the allowable rate. So, in the year of purchase, you have put to use an asset for how many days? Less than 180 days. Then you can charge only 50% of the normal depreciation as a deduction. Otherwise, you can claim full rate of depreciation as a deduction. In all other cases, you can definitely charge 100% of the normal rate as what? Depreciation. This is what the department says. Are you all listening? So that is either full or half. Are you all here? Are you able to follow what I said? So you have to be careful. Only in the year of purchase, that too you have to check the put to use, not the date of purchase. You have to start from the date of put to use and till the year end. If from the date of put to use till the year end, if it is more than 180 days or exactly 180 days, full rate. If it is less than 180 rate, half the rate. That's what the department says. Next one. Next point. Listen. Earlier I said you have to use an asset for your business or profession. Are you with me? So usage is a important condition for claiming depreciation. Are you all here? Let me ask you one simple doubt. There are fire extinguishers in every building. Okay. Are the building owners using this fire extinguisher every year? No. They don't have to use it because departments say kept ready for use is also actual usage. Kept ready for use is also considered as what? Actual usage. You don't have to switch on an asset. If it is installed and kept ready for usage, then that is considered as put to use only. You don't have to actually turn on an asset. Or rather, I will give you a hypothetical example. Say I bought a generator. This year there was no current or power failure. So I installed the generator but I didn't turn it on. Can I claim depreciation? Yes. Once installation is done, it is kept ready for use. Kept ready for use is considered as actual usage only. So that's what point number 2 is An asset can be said to be in use even when it is kept ready for use. That is, usage means passive as well as active usage. Passive usage is also considered as put to use. Moving on to the third one, it is about deemed ownership. There's a concept called deemed ownership. So let me give you an example for this deemed ownership as well. Listen, say I took a building for rent. This building, I took it on rent. Okay, and there was a building owner. With the owner's permission, say I expanded this particular building. I've done some expansion work in this particular building with the owner's permission by expending 10 lakhs. Now you tell me, who incurred this 10 lakh expenditure? Tenant. The tenant incurred this 10 lakh rupees from his pocket. Now you tell me, who is the owner of this building? It is the original owner only. Tenant incurred some kind of expansion work. That doesn't mean that tenant is the owner of that expanded area. Original owner is the owner still after the expansion. The owner clearly mentioned tenant that if you want to do some expansion, you do it from your pocket. Even after that, I will be the owner. I have no plans to give away any percentage of ownership to you. If you want to do business, you expand it. This is what my building is. If you want to do something, you do it from your pocket. I have no plans to spend anything, and I have no plans to give this building in your name as well. So even after expansion, the building owner is the same. There is no change in the building owner. Tenant is only the tenant. But you tell me, for this 10 lakh rupees, can the tenant treat it as a current repair and claim it as deduction under section 31? No, it's not a current repair because there is an expansion. That is a capital nature expenditure. So what department say? For this expanded area, this tenant shall be deemed to be the owner. For this expanded area, tenant shall be what? Deemed to be the owner. And tenant can capitalize this 10 lakh and charge what? Depreciation. This is only for the purpose of claiming what? Depreciation. Don't file a case in the court stating that according to the income tax law, I am the owner of this expanded area. That case will never stand. For the purpose of computing depreciation, the tenant shall be deemed to be the owner of that expanded area. That simply means the tenant can what? Capitalize that 10 lakh in his books of accounts and charge depreciation under section 32, even though he is not the original owner of that expanded area. Are you with me? So this is what the department say. Let's understand this theory. Assessee incurred capital expenditure for his business purpose on a building not owned by him, then the depreciation shall be allowed as if the said building is owned by the assessee. If you are incurring a capital expenditure on a building which is not owned by you, then that capital expenditure incurred by you, that portion shall be in your deemed ownership, and you can definitely charge what? Depreciation on that capital expenditure that you've incurred from your pocket. That's what the department says. I hope it is clear for you. Is that point okay for you? So moving on, friends, moving on with the other things here. So next is methods for claiming depreciation. How do you compute depreciation? Methods for claiming depreciation. That's what we are about to discuss right now. Income tax department recognizes only two methods for claiming depreciation. Number one, SLM, straight line method basis. Number two, WDV, written down value basis. So there are only two identified ways of claiming depreciation according to the IT Act. Number one, SLM. Number two, WDV. What is SLM? Straight line method basis. What is straight line method basis? Simple. Every year, the amount of depreciation that you are charging will be constant. Every year, the amount of depreciation that a person charges will be constant. That is called as straight line. You claim depreciation on a straight line. There won't be any fluctuation in the amount of depreciation. It will be constant every year. Now, who can claim depreciation in this method? If you are an assessee engaged in the business of power generation or power generation and distribution at their option. What do you mean by that? If you are a power generator or if you are in the business of power generation and distribution, and if you think that SLM is good for you, you can opt for SLM. Nobody is mandating that the power generators have to mandatorily go for SLM. It's not like that. If the power generators think that SLM is better, then they can charge depreciation in accordance with SLM basis. For all others, WDV is what? Mandatory, and for power generators, WDV is an option again. So the theory is simple. Power generators can choose between SLM and WDV. Once they choose, they have to follow it, okay? It is not like year 1 they can go with SLM, year 2 they can come back to WDV. It's not like that. Power generators have an option to choose between SLM and WDV. Once they choose, that is forever. They are not supposed to switch it in between. Are you with me? So, for power generators and distributors, at their option, they can charge depreciation under SLM basis. It's not mandatory, it's just like an option for them. Now, what is the speciality? The amount of depreciation shall be constant throughout the year of the asset. So, let's complete this part. I'll give you an example based on the SLM basis. So, please listen. I want all of you to be very attentive right now. So, let's do an example on SLM basis. Okay, say I'm a power generator. Purchase an asset having a value of 10 lakhs in say year 1. So depreciation for year 1 is say at 10%. 10% means how much, friends? 1 lakh. Depreciation for year 2 also will be what? 1 lakh. And year 3 also it will be 1 lakh. So SLM basis main specialty is the amount of depreciation that you are charging on an asset will be always constant. It will never change. So you tell me, what is the carrying value of this asset in year 3? What is the balance value of this asset in year 3? 8 lakh. Year 3 beginning, the value of the asset will be only 8 lakh. Now one more thing is there. When it comes to income tax department, if you are selling an asset in between a year, you cannot charge depreciation in the year of sale. You have to keep that asset with you in a year, then only you can claim depreciation over the asset. That means in the year end, if you are still the owner of the asset, then only you can charge depreciation. When you are selling an asset in between a year, you cannot claim depreciation till the date of sale. That concept is not there in IT Act. But in accountancy, it is like that. Till the date of sale, you can compute proportionate depreciation and charge it in your P&L. In income tax, they are not allowing it. If you are maintaining an asset, if an asset is there with you till the year end, then only you can charge depreciation. If you are selling an asset in between a year, you cannot charge depreciation till the date of sale. It is not permitted in IT Act. Are you with me? So in year 3, the balance value will be 8 lakh. Say year 3, I have sold that asset. I have sold that particular asset and will create different values. Say sold that asset for say 5 lakh. I have sold that particular asset for what? 5 lakh. If I am selling that particular asset for 5 lakh, you tell me how much is the balance value? 8 lakh. I have sold it for 5 lakh. Then I will end up in a loss. How much is that loss? 3 lakhs will be the loss. Yes or no? Department say what to do with this loss? Department say you treat that 3 lakh rupees loss as a depreciation and charge it under Pgbp by calling it as terminal depreciation. Are you with me? So this loss is treated as terminal depreciation and you can charge it under section 32. You don't have to treat it as a short-term capital loss and all. You can directly charge it as depreciation by calling it as what, friends? Terminal depreciation. Are you with me? So the point is very simple. Say you are an assessee who is a power generator and opted for SLM basis, and you have charged some depreciation on the basis of SLM basis. Now you are selling an asset at a loss. You are selling an asset at a loss. The loss that you incur is allowed as a deduction by calling it as terminal depreciation under section 32. Is that point clear? Is that point clear? Good. Moving on. What if I am selling this asset? I have sold this asset say for 9 lakh. I have sold this asset for what value, friends? 9 lakh. How much is the balance value in the books? 8 lakh. As per our books, the balance value is 8 lakh and I am selling it for 9 lakh. Then what is the profit that I am getting? Profit is 1 lakh. And department say if you are earning profit like this, then I have to treat it as what? Income taxable under section 41 by calling it as balancing charge. and it will be taxable as business income under section 41. Hope you remember. Under 41, there was a concept called as balancing charge, and I've told you that we will explain balancing charge when we explain depreciation. This was the one. This is the one. Point is very simple. If you are selling an asset for what? For profits. The profit that you are earning in relation to that particular asset is treated as what? Balancing charge. And you can claim that profit, or you have to show that profit as your deemed business profit under section 41. I hope it is clear. Not yet over. We can create one more situation over there. What if I am selling that particular asset, say for 15 lakhs? I have sold that particular asset for what? 15 lakhs. How much is the balance value of the asset? 8 lakh. How much is the total profit if I am selling it for 7 lakhs? Now what department say, if I am selling that particular asset for a value which is over and above its original cost of acquisition. If I am selling that particular asset for a value over and above its original cost of acquisition. What is the original cost of acquisition? 10 lakhs. What is the sales value? 15 lakhs. So whatever gain that I get when I sell that asset for a value which is over and above the original cost of acquisition shall be treated as gain under capital gains. So here, out of the 7 lakh, 15 lakh is the sales value and the original cost of acquisition is 10 lakh. So 5 lakhs will be treated as what? Capital gains. Not yet over. And how about the remaining profit of 2 lakh? The remaining profit of 2 lakh shall be treated as balancing charge. Under section 41, this is what the department says. The balance profit of 2 lakh have to be treated as what, friends? Balancing charge. Now you tell me, what is balancing charge? Imagine, say, in the same example, imagine I purchased an asset for 10 and I've claimed 1 lakh, 1 lakh. So total how much is the value of depreciation? 2 lakh as depreciation in 2 years. Then I'm selling this asset for say 10 lakh. I'm selling this asset for what value? 10 lakh. Then you can imagine, I've claimed 2 lakh as depreciation and I'm selling it for the original 10. So it is just like I've recovered the amount of depreciation that I've claimed in the past 2 years. In the third year, if I'm selling it for the exact 10 lakh value, then it's just like the recovery of depreciation that I claimed as a reduction in the past 2 years. Yes or no? Depreciation is allowed as a reduction from the taxable business profits. If I'm recovering that amount at the time of sale, then that 2 lakhs have to be treated as an income under Pgbp to balance the effect. That's why it's called as balancing charge. That 2 lakh rupees is a kind of a recovery of depreciation that you have claimed in the last 2 years. So to balance the effect, you have to treat that 2 lakhs as an income taxable under Pgbp. Pretty simple it is. Are you with me? And if you are getting a gain which is over and above that 10 lakh, that means the original cost of acquisition, that have to be dealt under capital gain. Don't put it under Pgbp. Why? Because you haven't claimed that excess as any reduction under Pgbp. So whatever excess profit that you are getting have to be dealt under capital gains. That's what the department says. I hope it is clear. This is the concept of balancing charge and terminal depreciation. It is there. Balancing charge and terminal depreciation, it is there. Depreciation for power generation undertakings. They can claim depreciation either on WDV or SLM. Terminal depreciation balance charge when they compute depreciation under SLM. Asset is sold, sale value more than balance value, excess shall be balancing charge. Sale value more than original cost of purchase, excess shall be capital gain. Sale value less than balance value, shortfall shall be terminal depreciation deductible under section 32. I hope the concept is clear for you. Are you all with me? Is that point clear till now? So let's move on, friends. We have completed which one? Straight line method of depreciation, and you tell me who can claim depreciation under SLM basis? Power generation or power generation and distribution, assessees can claim depreciation under SLM basis. That too not mandatory, at their option. Moving on with the next one, WDV. For all other assessees, WDV is mandatory. For all other types of assessees, WDV is mandatory, and for power generators, it is an option. In WDV, there are certain things that you have to be careful. In accountancy, how do we compute depreciation? On the individual value of an asset only, we claim depreciation in accountancy. Yes or no? On individual value of an asset, we charge depreciation in accountancy. In income tax, it is not like that. It is on the block value you claim depreciation according to the IT Act. Are you with me? In IT Act, every person charges depreciation on what value? Block value. On what value? Block value. Now the question is, what is this block? How to create a block? Let's understand. So, create a block and charge depreciation on the value of block of asset. That is, assets forming part of same category, same rate shall be under one block. There are 5 main categories. Asset that are coming under same category, same rate shall be treated as one single block. For that, you should know how many categories are there and which all are the rates applicable. Are you with me? Now listen, there is an important thing. In the original Income Tax Act schedule, there are n number of assets and n number of rates. Are you with me? There are n number of assets as well as n number of rates. Out of that, only important ones have been given over here. You should mandatorily study the assets, its category and the rate. This blue table that is given over there, you should mandatorily study the assets, its category and the applicable rates. You should by heart it. Why? Because I've seen questions where they have given the asset value only and they have not provided the rate of depreciation. So you should at least know this much rates and this much assets value. So we'll start with the type of asset first. Thereafter, I'll tell you how to create a block. Rate of depreciation, important ones only. First one, that is residential building. Category, which category? Building. What is the rate? 5%. What is residential building? Say a manufacturer have a guest house for workers. That guest house is basically a residential building. For the guest house, the manufacturer should charge only 5% depreciation. Temporary structure. Which category? Building. What is the rate? 40%. What is temporary structure? Say especially in the construction site and all, you can see this temporary structure with wooden sheets or aluminum sheets, etc. Have you seen this? Those temporary structures, what is the rate of depreciation? Only 40%. Wooden structures, etc. For other building, then rate shall be 10%. Say for example, for a manufacturer, the factory building, rate shall be 10%. Are you with me? Now let me tell you one more thing over here, which is not given, but it is there. How about a hotel? For a hotel, their main building is a residential building. I'm not talking about the restaurants. I'm talking about hotels. Their main building is residential building. What is the rate of depreciation? It's 10%. It is 10%, not 5%. Are you with me? So for hotels, even though their main building is a residential building, they can charge depreciation at 10%, not at 5%. So these are the 3 items that are coming under the category building. Second one, furniture and fittings. Which category? Furniture. So what is the rate? 10%. What is this fittings? Fittings means this light, fan, sockets, switch, bulb, etc. Light points, etc. is called as fittings. Are you with me? Furniture and fittings means this light, fan, switches, sockets, etc. are called as fitting. AC is not a fitting. Even though it is fitted in the building, don't call AC as a fitting. AC is a normal plant and machinery only. Are you with me? But fan you can say as a fitting. So that was furniture and fittings. Moving on to the next category, that is plant and machinery. First one, motor car. What is the rate? 15%. Second one, motor vehicle running on hire. What is motor vehicle running on hire? You are running a rent-a-car business. Then that motor vehicle is running on hire. Or you are in the goods transportation and you are using lorry, trucks, etc. for your business. In that case, you can charge a depreciation at 30%. Then computer including computer software. What is the rate? 40%. Aeroplanes, aero engines, etc. What is the rate? 40%. Then pollution control equipment. Have you seen pollution control equipment in certain factories? You can see something which is revolving over the roof of the factory. There will be pollution control equipments, and what is the rate? 40%. Windmill under plant and machinery. What is the rate? 40%. Intangible asset, that's not plant and machinery. So we'll complete plant and machinery. Okay. The next one, books. Whether it is annual publication or otherwise, under plant and machinery, and the rate is 40%. What do you mean by annual publication? Income tax related books are always annual publications. Accountancy related books are not annual publications. So whether it is an annual publication or not, you can charge depreciation at 40%. Then electronically operated vehicles, rate of depreciation shall be 40%. You can write 40 over there. Electronically operated vehicles, EVs, Nexon EV, Cur EV, etc. Electronically operated vehicles, you can charge a depreciation at what rate? 40%. Then plant and machinery general rate is not 20, it is 15%. Plant and machinery general rate is what? 15%. And there is one more category, that is ship. What is the rate? It is 20%. For ship, the rate of depreciation is how much? 20%. It has been juggled. So mistakenly, ship should be 20, plant and machinery should be 15. Okay, that you have to correct it. Now, one more asset is over there, that is intangible asset. What all are intangible asset? Know-how, patent, copyright, trademark, licenses, franchises, or any other business or commercial right of similar nature, not being goodwill of a business or profession. Okay, what is that? Goodwill is never depreciable according to the income tax law. Earlier it was depreciable, but department say, how can goodwill depreciate? That's what department says. If you're doing good business, you will always have goodwill. If you're doing wrong business, then definitely you will lose the public image. So in the normal course of business, goodwill never depreciates. So you cannot charge any depreciation over the value of goodwill. So excluding goodwill, the rate of depreciation shall be how much? 25%. For intangible asset, the rate of depreciation shall be 25%, and I hope it is clear for you. So these are the minimum rates that you should study for your examination, and I hope these are clear for you. Now, one more thing is there. Mobile phone, EPA, BX, etc. are always depreciable at 15%. You know what is mobile phone? What is EPA, BX? Telecommunication devices, like walkies, intercoms. That phone you press on 3 or 9, call will go to the reception. Those things, intercoms, interconnected devices. You can charge depreciation only at 15%. It is not computer basically. So you can only charge 15% depreciation for those assets. How about UPS? Then printers and scanners. UPS, printers, scanners, etc. are considered as computer only, and you can charge a depreciation at 40%, because UPS, computer, scanners are actually computer peripherals. So they are considered as computer, and you can charge a depreciation of what percent? At 40%. Are you all here? Now the question, how do you create a block? Very simple. Say, I have plant and machinery 1, plant and machinery 2, plant and machinery 3. Plant and machinery 1, I bought it for 10 lakh. Plant and machinery 2, I bought it for 5 lakh. Plant and machinery 3, I bought it for 3 lakh. Then what I need to do? Add everything. The total value will be 18 lakhs. Then charge depreciation on this 18 lakh. Bus. I don't have to individually compute the depreciation in WDV basis. It's all about the block. And how do you create the block? Same category, same rate assets have to be picked, added together, create it as a block. Then on the entire block value, you charge the depreciation. This is how you claim depreciation according to the income tax law. Are you with me? Are you with me? And practically, you don't have to create a block because it is already there in the ITR schedule. You only have to fill the value. But in examination, you have to create a block. What block I'm talking about? Depreciable block. Okay. So, in Income Tax Act, you must, for your examination, you must create a block, same category, same rate assets are clubbed together and brought it together, make it together as a single block. And on the entire block value, you charge the depreciation. That is how you claim depreciation as per IT Act. Now, there are other things, that is computation of depreciation. How do you compute depreciation under WDV method? Let's see. This is the format for computing depreciation under WDV basis. So, what you need to do is, what is the first one? WDV of a block at the beginning of a year. You take the WDV of a block at the beginning of a year. That means last year, closing WDV will be this year's opening WDV. Then add assets falling within the block acquired during the previous year. Listen, this is a statutory format. With the opening WDV, always add additions first. What is addition? Newly acquired assets during that year is said to be what? Additions. Always with the opening WDV, you should add additions. Then consider or compute opening plus addition. Thereafter only you are supposed to deduct sales value from the block. Are you with me? Imagine your sale was on April and your purchase was on December. Your sale was on April 2024 and purchase was on December 2024. Then also you have to add additions first. Then only the sales. So it does not depends upon the order or the date chronology. What you need to do, always add additions. Then you delete the sales. It's a statutory format and you must follow this. Are you here? Then after sales value, the written down value, and they have written, it cannot be negative. Why it cannot be negative? Why? Because of operation of section 50. That we will cover after completing additional depreciation. I will take section 50 under 32 itself. That's a part of capital gains. But we will cover section 50 as a part of 32 itself, so that your understanding over the topic will be better. So listen, WDV of that particular asset cannot be negative. On the closing WDV value, you charge the depreciation. And the rest will be the closing WDV, and this closing WDV will be the opening WDV for your year 2. Is that clear? Is that clear? Super. So opening, additions, opening plus addition, then deletion, then on the remaining WDV you charge the depreciation, then whatever value that you have after charging the depreciation shall be the closing WDV, and that will be the opening WDV for next year. I hope it is okay for you. So we have just completed the concept of normal depreciation. So moving on, friends, where were we were dealing with the normal depreciation. Now we have another thing called as what? Additional depreciation on plant and machinery, which is under section 32 subsection clause number 2A. Under 32, it's clause number 2A. What is that? Say, if you are a manufacturer or you are engaged in the business of generation or transmission or distribution of power and you have opted for WDV. If you are a manufacturer or you are a power generator, but power generators should opt for WDV to claim additional depreciation. Then additional depreciation is allowed on what? New plant, machinery or plant acquired and installed by the assessee. And additional depreciation can be claimed only in the first year of purchase of an asset, and the rate of additional depreciation shall be at 20%. So there are certain questions. Number one, can every assessee claim additional depreciation? No. If you are a manufacturer or you are in the business of power generation and distribution and opted for WDV only, you can claim additional depreciation. That is point number one. Point number two, Can assessee claim additional depreciation every year? No. Only in the first year of purchase of an asset only you can claim what? Additional depreciation. Next question. What is the rate of additional depreciation? That you know it is 20%. Next question. Can you claim additional depreciation on the entire plant and machinery value? Again, the answer is no. You can claim additional depreciation only on eligible plant and machinery value, not on the entire plant and machinery value. Are you all here? You cannot claim additional depreciation on the entire value of plant and machinery. You can charge additional depreciation only on the eligible value or eligible plant and machinery value, that too only in the first year of purchase. Now the question is, what all are the eligible plant and machinery? So department is not saying which are all the eligible plant and machinery, but department comes up with a negative list. Which all are not eligible plant and machinery, they are saying. That means all other plant and machineries are what? Eligible. So this is a kind of a negative list where all other type of plant and machineries are what, friends? Eligible. So what all are the negative lists? Ship and aircraft. You cannot claim any additional depreciation. Can you charge normal depreciation? Yes, you can definitely charge normal depreciation, but additional depreciation is not permissible for both ships and aircraft. Next one, second-hand plant and machinery. You cannot charge additional depreciation for second-hand plant and machinery as well. Then, what is next? Office appliances or road transport vehicles. You cannot charge additional depreciation for office appliances as well as road transport vehicles. You know office appliance, right? And before that, what is second-hand plant and machinery? A plant and machinery which is already used by someone else is said to be what? Second-hand plant and machinery. You cannot charge additional depreciation on second-hand plant and machinery. Then, what is next? Office appliances or road transport vehicles. Whatever assets that you use in your office, you cannot charge additional depreciation. As well as road transport vehicle. What is road transport vehicle? On the value of motor car, etc., bus, trucks, etc., you cannot normally claim additional depreciation. But there is one point, not number one. What is that? Assessee can claim additional depreciation on trucks, dumpers, forklift truck, etc., if it is used inside the factory. What does that mean? There are certain factories where the area of factory will be huge, like 25 acres, 30 acres, 100 acres, etc. So in those factories, to transport your raw materials, they will be using dumpers from their stock house to the working progress, or from working progress to finished goods to the sales depot. So if a dumper or a truck, etc., or a forklift truck, etc., or a crane, etc., used exclusively inside the factory, then you can definitely charge what? Additional depreciation. Are you with me? If a truck is running from your factory to a sales depot which is outside the factory, no additional depreciation. If it is used exclusively inside the factory, then definitely you can claim additional depreciation. So for forklift truck, dumpers, trucks, etc., you can definitely charge additional depreciation if it is used exclusively inside the factory premises. The next one, plant and machinery installed in office premises, residential accommodation, guest house. Generator in factory, you can charge additional depreciation. Generator at guest house, no additional depreciation. Computer in factory, yes, you can claim additional depreciation. Computer in office, no additional depreciation. And finally, any machinery or a plant where whole or a part of the actual cost is already allowed as deduction. Just like scientific research asset, specified business assets, etc., where you can claim 100% deduction on its capital expenditure in the year of purchase itself. For those assets also, don't charge any additional depreciation. Apart from these assets, for all plant and machinery, for all other plant and machinery, along with the normal depreciation, you will get additional depreciation at 20% on the first year of purchase. That's what this concept is all about. Are you with me? Moving on. Now, for the purpose of claiming additional depreciation, printing and publishing shall be considered as manufacturing. If you are in the business of printing and publishing, that activity is considered as manufacturing for the purpose of claiming additional depreciation. Basically, it's a service. Yes or no? You have to pay GST for printing services. But income tax department say, for the purpose of claiming additional depreciation, if you are in the business of printing, definitely that also will be considered as what? Manufacturing for the purpose of charging additional depreciation. That's what they are saying. I hope it is clear for you. Are you all here? Alright friends, so we were discussing about what printing and manufacturing is also considered as, printing and publishing is also considered as manufacturing for the purpose of charging additional depreciation. Now moving on friends, hope you remember, in the year of purchase, if you are put to use an asset for less than 180 days, then you can charge only 50% of the normal depreciation. Yes or no? Likewise, there is a restriction for additional depreciation as well. In the year of purchase, if you are put to use an asset for less than 180 days, you can only claim 50% of the additional depreciation as well. You cannot charge the entire 20% additional depreciation. You can only claim effectively 10%. But there is a problem. What is the problem? See, additional depreciation is only available in the first year of purchase. And it is not a violation that you are purchasing an asset for purchasing and using an asset for less than 180. It's not considered as any violation. So department is giving a lenient view. What they are saying is, if in the year of purchase you are put to use an asset for less than 180 days, you charge only 10% or you charge only 50% of the additional depreciation in year 1. The balance 50 can be claimed in year 2. Are you with me? So that is this point. 50% of additional depreciation to be allowed where plant and machinery is put to use for less than 180 days during the previous year in which the asset is acquired. The balance 50% of additional depreciation shall be allowed in the immediately succeeding previous year. So the balance 50 is allowed as a reduction in the immediately succeeding previous year. That's what the department says. I hope it is clear. So it's like a 50-50. Year 1, you claim entire 20, you charge entire 20 and only claim 50. Balance 50 next year. Are you with me? So that's what the department say in relation to what friends? Additional depreciation. So let's summarize additional depreciation. You tell me who all can claim additional depreciation? Manufacturer or power generator who opted for WDV. On what plant and machinery they can claim? Eligible plant and machinery. What is the rate? 20%. Only in the first year of purchase they can claim additional depreciation. I hope these points are clear for you. So we were discussing about additional depreciation. Now it's time for us to discuss another concept, that is, what if there is a sale of asset from a respective block? Are you all listening? So when you are computing depreciation under a WDV basis, what if there is a sale of an asset from a respective block? How to deal with that particular sale? Basically, this is capital gain. But I'm teaching section 50 as a part of Pgbp. Why? Because you will get a better understanding over that particular topic. So computation of capital gains in respect of depreciable assets, that's what we are about to discuss right now. So friends, listen, it's pretty simple. First of all, before explaining the theory, I'll give you an example so that you will understand the theory in a better manner. Okay. So let's take an example. Say I have plant and machinery A, plant and machinery B, and plant and machinery C. These are depreciable at 15%, and right now the written down value of this plant and machinery block is 10 lakh. This is not the written down value of an individual asset. This is the written down value of the entire block, and the value is how much, friends? 10 lakhs only. Are you all with me? Now listen. So here the question is, what is the individual written down value of plant and machinery A? We don't know. What is the individual written down value of B and C? That also we don't know. We don't have to know. The only thing that you have to know is the combined value of plant and machinery A, plant and machinery B, and plant and machinery C. All together the value is how much? 10 lakhs. That is the only information that we have. Now, in this case, say, imagine I'm selling plant and machinery A, say for 7 lakh rupees. I've sold plant and machinery A for what value? 7 lakh rupees. Say I've sold plant and machinery A for 7 lakh rupees. So as you all know, When I'm selling plant and machinery A for 7 lakhs, there is a sale from a respective block. Are you with me? So how do we deal it? First, you have to take the opening WDV of the block. How much is the opening WDV of the block? 10 lakhs. Then you have to deal with the additions. Is there any additions in the block? No. Then opening plus additions, how much will be the value? The same, 10 lakh. Now you need to check whether there is any sales from that respective block. There is a sale, that is plant and machinery A. And how much is the sale value? 7 lakh. So after the sales, you have to check two things. Is there any value remaining in the block? Yes, because the WDV value of the block was 10. The sale value was only 7. So there is a value remaining in the block. And how much is the value remaining in the block? 3 lakh. You need to check one more thing. Is there any assets remaining in the block? Is there any assets remaining in the block? And there are plant and machinery B and C is there in the block. So there is value and there is asset. Don't need to compute any capital gain. When you are selling an asset from a respective block, after the sales, if there is asset as well as value remaining in the block, you don't have to compute any capital gain. Rather, what you can do is, you can charge depreciation at 15% on the remaining value. That's what the department says. So whenever there is a sale of asset from a respective block, after the sale, you have to check two things, whether there is asset remaining in the block as well as value remaining in the block. If both are there, don't compute any capital gain. You compute or you charge the depreciation on the remaining value. That's what the department says. Are you with me? Example number 1. Example number 2. I've sold plant and machinery A, say for 12 lakhs. I've sold plant and machinery A for what value? 12 lakhs. You tell me how much is the opening WDV? Opening plus addition, it is 10. Yes or no? Opening plus addition. There is no addition. The opening is the opening plus addition, 10. And there is a sale value. How much is the sale value? 12 lakhs. Now, is there any remaining value in the block? Don't write negative values in the block. Is there any remaining value? No. Because the sale value exceeds the WDV plus addition of that particular block. Yes or no? If the sale value exceeds the written down value plus addition of that respective block, that excess shall be short-term capital gain in accordance with section 50. It's a deeming fiction. That excess shall be short-term capital gains in accordance with section 50. How much is the excess? 2 lakhs. So this always have to be treated as a short-term capital gain. Now there is another thing. How many assets are there in the block? We have B as well as C. Now, can you charge depreciation on this B and C in future? No. Why? Because there is no value remaining in the block. So, in future, you cannot charge depreciation on B as well as C. Whenever you sell B or C in future, the entire sale value exceeds the block value because the block does not carry any value right now. If you are selling that B or C in future for whatever value, that value always exceeds that times block value because the block does not have any value. Now, that is case number 2. And case number 3, or example number 3, we can say, I am selling plant and machinery A, plant and machinery B, and plant and machinery C all together for 6 lakhs. Not 6 lakhs each. It is all together for 6 lakhs. Opening plus addition, you know how much is the value? 10 lakh. And how much is the sale value? Only 6 lakhs. Now, as you all know, there is what? Value remaining in the block. And how much is the value remaining in the block? 4 lakhs. But there are no assets remaining in the block because I've sold all the assets. I've sold all the assets, but there is no value in the block. Sorry, I've sold all the assets, but there is some value in the block. What to do? I cannot charge depreciation. Why? Because there are no assets in the block. So what to do? I have to treat this 4 lakh as a deemed short-term capital loss under section 50. Under section 50, this 4 lakh shall be treated as deemed short-term capital loss, and I have to adjust it with the other capital gain profits. This is what the department say. On this block, you cannot charge any depreciation in future. You can write the block value as nil. and charge that 4 lakh as what? A short-term capital loss. Are you with me? So the theory is very simple. If there is a sale from a block where you charge depreciation under WDV basis, the one thing that you have to check is what? Whether the sale value exceeds block value. If the sale value does not exceed the block value and assets remaining in the block, example 1, no capital gain, charge depreciation on the remaining value. Situation 2, if the sale value exceeds the block value, then the excess shall be deemed short-term capital gains. Case number 3, if the sale value exceeds or does not exceed the block value, that means there is something value balance, but there are no asset pending in that respective block, then the balance value shall be treated as short-term capital loss. Now let's get into the theory. So what is the theory? Asset is sold from a relevant block. The first thing that you have to check is after sales, if assets remaining in the block. After the sale, you have to check whether there are assets remaining in the block. If the answer is yes, net sale consideration, you need to check whether it is more than the entire WDV of the block. What? Net sale consideration. What is net sale consideration? Sale value minus direct expenses are called as net sale consideration. Say there is some brokerage or something, then you need to net off that particular brokerage. So you have to consider the net sale consideration. So that net sale consideration, you need to check whether it exceeds the block value. If it exceeds the block value, then what you need to do? The excess shall be deemed to be short-term capital gain. That's what the department says. So if the net sale consideration exceeds the entire WDV of the block, then the excess shall be deemed short-term capital gain. You tell me which example is that? According to that example that we have learned, this was example number 2. There is a sale and the net sale consideration is more than the entire WDV. The 2 lakhs shall be deemed to be short-term capital gain. Hope you remember. And what if the net sale consideration is less than or equal to the entire WDV of the block? No capital gain, claim depreciation on the balance value. That was example number 1. Are you all here? Then, after sales, if no assets are remaining in the block, so you sold the asset and there are nothing remaining in the block, and there also if the net sale consideration is more than the entire WDV, excess shall be deemed short-term capital gain. I haven't given an example on this. Say I am selling plant and machinery A, B and C for 15 lakh. The WDV is only 10. So that excess is 5. So that 5 shall be short-term capital gain. There are no assets remaining in the block. Not a problem because the value already exceeded the WDV value. So that excess you treat it as what? Short-term capital gain. Are you with me? And now, after sales, if no assets are remaining in the block, then net sale consideration is less than or equal to the entire WDV of the block, then no short-term capital gain. On the balance value, if any, shall be deemed short-term capital loss. There are no assets but value. Then you show the value as deemed short-term capital loss. Why? Because you cannot charge depreciation without any asset in the block. So you treat that remaining value as your short-term capital loss and you completely write off that particular block. That's what the department says. Is that point clear? So this is all about section 15. Basically it is capital gain, but we have studied it under Pgbp for a better understanding of that particular topic. So have a plain reading over this chart, friends. Again, something related to depreciation only. Depreciation in certain special cases. It's a fantastic thing. Depreciation in certain special cases. All right. Listen. See, there are certain events. There are certain events where department does not consider those events as a sale. Okay. Say for example, I will give you the list of the events where department does not consider those events as a sale. Say for example, succession of a firm or a sole proprietary concern by a company. What do you mean by succession of a firm or a sole proprietorship concern by a company? Till yesterday you are a firm, you were a partnership firm. Now you are planning to convert that firm into a private limited company. All the partners will become the shareholders. So this is basically a conversion. When you convert partnership firm into a what do you say, a private limited company, there are actually two persons. Till yesterday it was firm and today it's a company. And there will be transfer of capital assets from the firm to the company. But it is not an outside transfer because it is only a reorganization. You are restructuring your legal form. So what departments say, it is not a sale. Whenever there is a succession of a firm or a sole proprietary concern by a company, whatever assets that you are transferring in relation to that succession, that is not considered as a sale because basically it's a business reorganization. Number two, conversion of private company or an unlisted public company into LLP. You are converting your private company or an unlisted company into what? LLP, limited liability partnership. That is also business reorganization. Or amalgamation. What is amalgamation? Two companies, they are merging together to form a new company. That is called as amalgamation by way of merger. One more amalgamation is there, that is amalgamation by way of absorption. One company is absorbing another company, and that is called as amalgamation by way of absorption. In amalgamation also, it is not like, amalgamating companies selling their assets to amalgamated company. It is just like another business reorganization. And the same with demerger also. What is demerger? A company have two divisions. One division will be transferred or one division will be converted as another new company. So there will be demerged company, the original company, and the new company will be resulting company. So in that case also, there will be transfer of asset from the demerged company to the resulting company. So these are not actually an outside sale. These are only business reorganizations. The successor or the amalgamated company or the resulting company, as the case may be, can claim depreciation as if the succession, business reorganization or amalgamation or demerger had not taken place. In the year of succession or amalgamation, the amount of depreciation shall be apportioned between two entities in the ratio of number of days for which the assets were used by them. Two things are there. I'll explain that point by way of an example. Listen, we will take the example of, say, partnership firm is getting converted into a company. Say there is a partnership firm and it is getting converted into a company. The conversion happened on, say, 1st January 2025. This was the date of conversion. Are you all listening? 1st January 2025 is the date of conversion. See, during the conversion event or during these processes, this partnership firm had some plant and machineries. They had some plant and machineries having a value of rupees 10 lakh. This was actually plant and machinery which was there as a part of the opening block of asset as on 1st April 2024. On 1st January 2025, there is a conversion happened, and from 1st January 2025 onwards, who's gonna make use of that plant and machinery? The company. Since it is not a sale, you don't need to compute any capital gain and all. But what you need to do is, in that year, both this partnership firm as well as the company have used that particular plant and machinery. So what you need to do is, you need to take the entire value of the plant and machinery, charge depreciation at 15%, that will be rupees 1,50,000, then proportionate this depreciation based on the number of days of use by the partnership firm as well as by the company. So 1,50,000 divided by 365 into how many days partnership firm used that particular asset? Let's see, it is 275 days. Or rather, it is better to find out the number of days used by the company first. How many days the company used that particular asset? January 31, February 28 and March 31, that is 90 days. So 1,50,000 divided by 365 into 90 days. How much will be the proportionate depreciation? 90 days, okay. It is 30,986. You can round off the decimals, okay. Now, 36,986 rupees can be charged by the company. And how much is the balance number of days? 275 days. 365 minus 90. So how much will be that? 1,13,014. So 1,13,014 can be claimed by the partnership firm. This is what you are supposed to do. In the year of amalgamation, demerger, conversion, reorganizations, etc., you compute the entire depreciation and then bifurcate it between the successor and the predecessor. This is what the department says, because we are not treating these events as a transfer or a sale. So you have to split the depreciation. One more thing is there. Now, from the next year onwards, this company is exclusively using that particular plant and machinery for their business. For the company, there should be an opening WDV. And what should be the opening WDV for the company? Last year's opening WDV was 10. Last year altogether you have claimed a depreciation of 1,50,000. So the remaining 8,50,000 shall be the company's opening WDV for the next year. Are you with me? Maybe during the conversion, they might have valued this plant and machinery, and company might have taken this plant and machinery by putting a value. But that value does not have any prominence while computing depreciation. You have to completely ignore that value which is considered by the company at the time of conversion. You need to stick on to the WDV value. That's it. Takeover value, they might be valuing the plant and machinery, and there will be some kind of a takeover value. Ignore the takeover value. You need to consider the closing WDV of that year as the opening WDV of next year. That's it. Is that point clear? This applies for conversion, amalgamation, demerger. Everything is same. The concept is same. So I hope that also was clear for you. Let's solve a question for that as well, so that you will get a better understanding over that topic as well. So please take your question number 4 and solve it, friends. Question number 4. So friends, Sai Limited has a block of asset carrying 15% rate of depreciation. So there's a company called Sai Limited, okay? And what is their problem? They have a block of asset, and what is the rate of depreciation that they charge on that respective block? 15%. And they bought it on 1st April 2024, okay? On 1st April 2024, they had this, and the WDV value of that respective block is 40 lakhs. It purchased another second-hand plant and machinery of the same block on 1st November 2024. 1st November 2024, they purchased the second-hand plant and machinery having a value of 14.40 lakhs. Now, and put use on the same day. Sai Limited was amalgamated with Shruti Limited with effect from 1st January 2025. On what happened is on 1st January 2025, there was an amalgamation, maybe by way of an absorption. Sai Limited got amalgamated with Shruti Limited, another company, and this is basically Sai Limited. Great. Then, what else? You are required to compute the depreciation allowable to Sai and Shruti for the previous year ended on 31st March 2025. Assuming that the assets were transferred to Shruti at 60 lakhs. So there is a transfer value for the asset that you can ignore, because according to the income tax law, they are not identifying the transfer value because it's only a business reorganization, not an outside sale. Also assume that the plant and machinery were purchased by way of account pay check. What is the logic of that assumption? That is the next topic, computation of actual cost. That I will explain later. So what you need to do is, we will consider the opening WDV first. This asset you have purchased on, or it is there from 1st April 2024 till 31st March 2024. So 40 lakh is the opening WDV, and for the whole year you can charge 15% as depreciation. How much is 15% on 40 lakh? 6 lakhs is the depreciation for the whole year. Yes or no? Now on that 6 lakhs, both Sai and Shruti have a claim. Yes or no? And how is the claim of Sai? First, we will think about Shruti. Shruti is using that particular plant and machinery from 1st January 2025 onwards. So, as you all know, from 1st January 2025 till year end, how many days are there? 90 days. Are you with me? Now, what Shruti can do is total depreciation of 6 lakhs divided by, for the whole year, 365 into 90. And can you tell me how much will be the figure coming? 1 lakh 47,945 will be the amount of depreciation that can be claimed by Shruti. Now, how about Sai? 6 lakh divided by 365 into how many days used by Sai? 275 days. And can you help me with the math? 4,52,055 rupees. That is in relation to the opening WDV. Now, there is a second hand plant and machinery bought by Sai and it is transferred to Shruti on 1st January 2025. In relation to the second hand plant and machinery, there is another thing. It is purchased from 1st November 2024 onwards. So, that is less than 180 days. Both of Sai and Shruti put together less than 180 days. So, if it is less than 180 days, then 14,40,000 into 7.5 percentage. And can you tell me how much will be the total depreciation? 1,08,000. This 1,08,000, you have to be very careful with one thing. How many days this asset were used for the whole year? From 1st November to 31st March. Don't divide it by 365. Because the entire asset is not used for the whole year. Are you with me? For the whole year, what is the total number of days of use? November 30, December 31, January 31, February 28, March 31. So, how many days are there? 151 days are there. So, this asset has been used only for 151 days for the whole year. So, you have to do the proportion based on 151 days. So, the total depreciation is 1,08,000. So, 1,08,000 divided by total 151 days. Out of that, Shruti used it for 90 days. And can you tell me the proportionate depreciation? 64,370. And how about Sai? See, 1,08,000 is the total depreciation divided by 151. And how many number of days is there? 61 days. November 30, December 31. So, can you tell me how much is the proportionate depreciation? 40? 629. So, adding these two together, how much is the total depreciation of Sai? Both the opening as well as second hand plant and machinery proportionate depreciation. How much will be the total? 4,95,684 rupees. How much for Shruti? 147 plus 64. And how much will be the total, friends? 212,316 will be the total depreciation for Shruti. This is how you have to compute the answer. That's what I've told you. You have to be careful with the dates. If an asset is not used for the entire 365 days, then don't take the denominator as 365. It is absurd. Are you with me? You have to be careful while doing the math. So, moving on, friends, with the next concept in this particular chapter, that is computation of actual cost. So, friends, listen. We charge depreciation on what value? On actual cost value. So, a computation of actual cost. So, friends, tell me, we charge depreciation on what value? On actual cost value of an asset. It's not purchase cost, but it is actual cost. So, what Act says, every assessee have to charge depreciation on the actual cost value of an asset. So, the question is, what is this actual cost? Let's understand what exactly is this actual cost. Listen, actual cost simply means you first take the purchase cost. You first take what? Purchase cost. Then you add installation expenses, transportation cost, loading, unloading, trial run cost, and all other expenses up to put to use. Whatever direct expenses that you are incurring in relation to purchase of an asset have to be considered as a part of the actual cost. Whatever cost that you incur in connection with purchase of an asset have to be considered as actual cost. Say, for example, loading, unloading, transportation, packing, etc. always have to be considered as a part of actual cost. Then add interest on loan taken for acquiring an asset up to put to use. Hope you have studied borrowing cost in your accounting standards. See, I'll give you an example for this. Say, listen, I'm purchasing an asset having a value of 10 lakh. That is the purchase cost of an asset. I took a loan of rupees 10 lakh at an interest rate of 12%. Okay, I purchased this asset on 1st April 2024. The installation was completed on 1st January 2025. This asset required some installation period. So put to use was actually on 1st January 2025. Now you tell me, how much is the total interest on that particular loan? I've taken entire 10 lakhs as loan. So how much is the total interest? 10 lakh into 12%, it will be 1 lakh 20,000. That is the total interest on loan for the whole year. Out of this interest, from the date of loan till the date of put to use, proportionate interest have to be capitalized along with the actual cost of the asset. So from the date of loan, that is April, May, June, July, August, September, October, November, December. That means 9 months interest I have to capitalize. 9 months interest will be 90,000 rupees. So along with the purchase cost of 10 lakh, I have to add another 90,000 rupees as the actual cost, and my actual cost of the asset will be 10 lakh 90,000 on 1st January 2025. The remaining 30,000 interest cost is allowed as a deduction under section 36 as a loan taken for the business. Are you with me? So whenever you are purchasing an asset, by taking a loan, the proportionate interest cost of that particular loan up to the date of put to use have to be capitalized along with the actual cost of the asset. And you have to charge depreciation on the total actual cost in the applicable rate. That's what the department says. Are you all with me? You might have learned this in your borrowing cost. If an asset requires some qualifying period, then the borrowing cost during that qualifying period have to be capitalized. Something similar to that. Now, so that is what interest on loan taken for acquiring the asset up to put to use. Then what is the next one? Less any grant receipt for purchasing an asset. You are getting as a government subsidy for purchasing certain type of asset. You have to reduce that subsidy from the actual cost of the asset. Why? Because you are not spending it from your pocket. You are getting it as a subsidy. Are you with me? Moving on. Less payments or aggregate of the payment which exceeds 10,000 made to a person in a single day, otherwise than by way of an account pay check, account pay bank draft, ECS, or through prescribed electronic mode. That simply means when you are purchasing an asset, you have to make the payment. Yes or no? When you are making the payment, if a single day payment in relation to an asset exceeds how much? 10,000 rupees. Make sure that you have made the payment in either account pay check or account pay bank draft or electronic clearance system or through prescribed electronic mode like Aadhaar Pay, Google Pay, payment banks, etc., credit card, debit card, etc. If you are not making the payment in these 4 prescribed methods, then the amount that you have paid shall not form part of the actual cost. For example, 10 lakh is the total cost of the asset. 2 lakh paid in cash. 8 lakh through RTGS, through bank. So you can only capitalize 8 lakh. You cannot consider this 2 lakh as a part of the actual cost. Why? Because department don't want that money flow, that cash flow in the market. So they are saying that if the payment that you are about to make in relation to purchase of an asset in a single day exceeds 10,000, you have to be careful. You have to make the payment only through prescribed modes. When you are making the payment other than prescribed modes, then what will happen? For that portion, you cannot add it as a part of your actual cost. That is why in the most of the questions, there is an assumption. Assume that these assets are purchased by way of account pay check. Have you understood? So after adding and deleting all these things, the remaining figure that you get is said to be the actual cost for the purpose of depreciation as well as additional depreciation, and I hope it is clear for you. Now there is another thing that is called as actual cost in certain special circumstances. I'm not saying that this is very much necessary for the exam, but in that certain things are actually required for us. I'll cover only those points which are absolutely necessary for us. So actual cost in certain special circumstance. Circumstance number 1. It's a fantastic one. It's better to study that. Second-hand asset is purchased by an assessee and AO is satisfied that the main purpose of transfer of the asset directly or indirectly to the assessee was reduction of income tax directly or indirectly to the assessee. Then actual cost shall be the amount of amount which AO may, with the approval of Joint Commissioner, determine having regard to all circumstances of the case. For example, JK Private Limited is a company. They are purchasing a second-hand plant and machinery. Having a fair market value of 10 lakh. I purchased it for, say, 15 lakh. I purchased it for what value? 15 lakh value. It's a second-hand plant and machinery and the market value is only 10. I purchased it for 15. AO asked me a question, why you are purchasing the second-hand plant and machinery for 15 lakh which is available in the market for 10 lakh? If I cannot give a proper reply, then what will be the conclusion of AO? AO will say that you have shown an increased purchase price to claim more depreciation. If you claim more depreciation, your income tax liability will come down. So in this case, AO have the discretionary power to come over there and make your actual cost as the FMV. In such circumstances, AO will come over there and compute the actual cost. In such case, AO will come and will say that your actual cost is only 10 lakh. I will not allow you to show 15 lakh as the actual cost. Show only 10 lakh. Are you with me? This is the practical side of it. But in examination, if they give second-hand machinery or second-hand asset, fair market value is given and the purchase price is more than fair market value, then you have to assume that it is done for increasing depreciation and you have to show only the fair market value as the actual cost. Are you with me? When it comes to the examination, if these facts are there, you should trigger this particular circumstance. Second-hand asset purchase for a value which is higher than the fair market value, you should say it is for the purpose of claiming extra depreciation and you should bring it back to the fair market value. That's it. Then, what is a special circumstance number 2? Where an asset which had once belonged to the assessee had been used by him for the purpose of his business or profession, thereafter cease to be his property by reason of transfer, is reacquired by him. Long story it is. Then actual cost shall be the WDV at the time of original transfer of the asset or the actual price for which the asset is reacquired by him, whichever is lower. Fantastic item it is. Listen. Say what they are saying is, say I had an asset. I'm JK Limited, I had an asset. That asset's WDV in say 2021-22 was say 10 lakh. The asset has a WDV of how much? 10 lakh rupees. I sold it to Mr. A. I've sold it to Mr. A. Are you with me? Then in the year 2024-25, I repurchased it. I have some sentiments towards that asset. So I was in search of that asset and I repurchased that from the market. Say the repurchase price is 12 lakhs. The repurchase price is how much? 12 lakhs. The repurchase price should be the actual cost. Yes or no? But department say no, not possible. This asset was once used by you. At the time of sale, the original WDV value of the asset was only 10. Now you are repurchasing it for 12. So department say in this case, actual cost shall be the WDV at the time of original transfer or the repurchase price, whichever is lower. So here I can only show 10 lakhs as the actual cost. Are you with me? And I can charge depreciation only on 10 lakh. And what if the repurchase price is say 8 lakh? Then you can take the 8 lakh because that is your repurchase price. So we are not involving in that. If the repurchase price is less than the WDV value, you can take the repurchase price itself as the actual cost. Are you with me? So once you have used an asset, you sold it to someone and you are reacquiring it. At the time of reacquisition, what should be the actual cost? WDV at the time of original sale or the repurchase price, whichever is lower. I hope it is clear for you. The next topic that I want to focus is on carry forward and set off of depreciation. Say friends, say you have unabsorbed depreciation. What do you mean by unabsorbed depreciation? Depreciation is actually a mandatory deduction. Yes or no? Say your year 1 sales is 0, You have a plant and machinery which you bought for 10 lakh rupees, which is depreciable at 15 percentage. So depreciation will be 1 lakh 50,000. But from where do you charge this depreciation? Because your sales is zero. You don't have money or you don't have profit to charge that depreciation. Then what will happen to this 1 lakh 50,000 depreciation? This is called as unabsorbed depreciation. This is called as what, friends? Unabsorbed depreciation, because you don't have adequate profit to absorb that 1,50,000 depreciation. So you tell me what to do with that unabsorbed depreciation. You carry forward it to the next year. How many years you can carry forward it? Unlimited subsequent years you can carry forward that particular depreciation. You can carry forward unabsorbed depreciation for unlimited subsequent years, which is under section 32 subsection 2. And you can set it off with your future profits. That's what the department says. I hope it is clear. Coming back to the theory, what they are saying is unabsorbed depreciation shall be carried forward indefinitely till it is fully set off. You can carry forward it to indefinite subsequent years. Whenever you have a profit in future, you can set it off with that respective profit. That's what the department says. I hope it is clear for you. Great. So by that I can say whatever all the things which are revolving around depreciation is completely over. That was a one huge lengthy section we have studied, that is section 32 depreciation. In examination there will be something related to depreciation. Most of the questions there will be some adjustment related to depreciation. So you always must study the rates. Focus on WDV more. SLM, I have not seen a question in relation to SLM in your CA final paper or CMA final paper. Focus on WDV more.
Hello, my dear ones, this is CA Jose Kurian, and this video is to inform you about how to purchase our book as well as recorded lectures. For the book, you visit www.cajosekurian.com. Then you scroll down and you can see our both handbook as well as workbook for CA as well as CMA, Inter as well as Final. For the lectures, you scroll up, then click on to the classroom. In the classroom, you can scroll down and you can see all courses listed. We have CMA Final English as well as Malayalam, then CA Final English as well as Malayalam, then we have CA Inter English as well as Malayalam. Then select your course, make the payment, and you will get instant access. Alright, now what are you waiting for, friends? Subscribe now. All the very best, take care, and God bless you all.